title, An Unprecedented Investment for Historic Results. How federal support for MDIs and CDFIs have launched a new era of disadvantaged communities. I now recognize myself for 5 minutes to give an opening statement. Minority Depository Institutions, or MDIs, and Community Development Financial Institutions, or CDFIs, are lifelines to our communities. According to the latest data, there are 146 MDI banks, 518 MDI credit unions, and 1,333 CDFIs, including nearly 600 non-depository loan funds. At a time when the pandemic placed many businesses owned by people of color at the brink of closing or permanently being closed down, MDIs and CDFIs jumped into action and provided much needed support and relief. When millions of Black and Latino Americans found themselves shut out of traditional financial institutions, CDFIs and MDIs provided fundamental support to the long-term financial well-being of many. For that reason, I worked with Representative Velasquez, who is also the chairwoman of the Small Business Committee, to secure $60 billion in PPP funding for community financial institutions, including MDIs and CDFIs, to ensure relief reached underserved and minority-owned businesses after the largest banks ignored them. Several committee colleagues, including Representatives Meeks, Beatty, and Green, drafted legislation to support MDIs and CDFIs, and I worked with Ranking Member McHenry and our Senate counterparts, as well as Senator Warner, to include key provisions of my comprehensive bill, the Promoting and Advancing Communities of Color through Inclusive Lending Act, in the COVID-19 relief package passed in December 2020. Specifically, the bill included an unprecedented $12 billion in capital investments and grants to strengthen MDIs and CDFIs and help them reach unserved communities. Additionally, the private sector, including mega banks, have made a lot of promises to address racial inequality and support MDIs and CDFIs the last few years. So we've invited mega bank CEOs to testify, and we will continue to monitor their efforts to fulfill their commitments. The impact of our support for CDFIs and MDIs has reached communities all across this country. For example, in 2020, CDFIs provided loans and investments to more than 162,000 businesses and nearly 4 million consumers. They financed 50,000 affordable housing units and hundreds of grocery stores, markets, and fresh food projects. While our work has provided some success, we should bear in mind the number of MDIs has declined by about a third in the decade following the 2008 financial crisis. With the number of Black banks declining by half, also MDIs and CDFIs face barriers to adapting to changes in the financial services marketplace and accessing opportunities to meet the unprecedented needs of communities in this pandemic. What's more, the $9 billion Emergency Capital Investment Program was oversubscribed by $4 billion in funding requests that will go unmet, suggesting that Congress should provide more support. And so I look forward to hearing from our witnesses on these issues and learning what additional steps we can take to further support CDFIs and MDIs, and in doing so, strengthening our Black and Latinx communities. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 5 minutes.
Thank you, Madam Chair. More than a year ago, Congress created the Emergency Capital Investment Program to support our nation's Cdfis and MDIs. This program was designed to provide specific funding and capital to help communities recover from the economic downturn caused by the pandemic. Funds have been allocated but have not yet been delivered. And I look forward to seeing the impact of this type of program and that it could have. Unfortunately, since this bipartisan moment, we've witnessed Democrats' partisan actions slow our economic recovery. This has disproportionately harmed the very people this program was meant to support. We must never have we may never have a good understanding of what this program's effectiveness is now. But let's take a step back and look at the bigger picture here. Last month, the Bureau of Economic Analysis reported the economy grew at an annualized rate of 6.9% for the fourth quarter of 2021. Yet, initial estimates from economists show only a 0.7% annualized rate of growth for the first quarter of this year. Consumer prices are up everywhere. Just last week, we saw a 0.6% rise in prices. Over the last year, prices have gone up 7.5%, which is the largest yearly increase in the last 40 years. So if your wages have not increased by more than 7.5% over the last year, and I venture to say that most Americans haven't experienced that, then inflation has wiped away any wage gains they've made. For example, the Social Security Administration increased the cost of living adjustment to 5.9% over 2022. For the 70 million Americans receiving benefits, this is a monthly net loss. So what do all these stats mean? It means American families and workers are hurting and Democrat policies are to blame. If you don't believe me, let's look at a few more examples. Until last Monday, the labor force participation rate remained stagnant under this administration. Consumer sentiment fell through January, sinking to its lowest level since November of 2011. Overall confidence in the government's economic policies is at its lowest level since 2014. Oh, and the national debt has surpassed $30 trillion on top of that. And we don't have a government funding deal either. We can't spend our way out of this mess. We're also seeing the impacts of anti-competition regulatory policies, where Democrat policies seek to control consumer choices rather than fostering a competitive environment. Take fintech firms and non-bank lenders. For the unbanked and underbanked consumers, small businesses, and underserved communities, innovative financial products can be a lifeline. We should be doing everything we can to promote regulatory clarity for financial institutions and fintech partnerships to create a more inclusive financial system. Last week, the Federal District Court of Northern California affirmed the OCC's valid when made doctrine, further providing important regulatory clarity. This is positive, but much more needs to be done. So as we discuss the impact of Cdfis and MDIs, we cannot lose sight of the bigger picture here and the work that remains to return our economy to the record growth experienced before the pandemic. And with that, I yield back.
Thank you very much, Ranking Member McHenry. I want to welcome our distinguished witnesses. First, we have Mr. Bill Bynum, who is the CEO of the Hope Credit Union, the Hope Enterprise Corporation, and the Hope Policy Institute. Next, we have Ms. Nicole Elam, who is the President and CEO of the National Bankers Association. Next, we have Mr. Everett Sands, who is the CEO of Lendistry. Next, we have Ms. Luz Owitia, who is the CEO of the Action Opportunity Fund. Last, we have Mr. Michael Faulkner, who is the Dean's Professor of Finance at the University of Maryland Smith School of Business. Without objection, your written statements will be made part of the record. You have 5 minutes to summarize your testimony. You should be able to see a timer that will indicate how much time you have left in your testimony. Mr. Bynum, you are now recognized for 5 minutes to present your testimony.
Thank you, Chairwoman Waters. Good afternoon, Ranking Member McHenry and members of the committee. Madam Chairman, I'll be negligent if I didn't begin by thanking you, your fellow members of Congress and members of the administration for acknowledging the vital role that mission-driven CDFIs and minority depository institutions play in the nation's economic health, and for making what have been truly historic investments in CDFIs and MDIs that have already dramatically increased our impact in financially underserved places. As a CEO of an organization that works in a region where I cannot drive for an hour without hearing echoes of social and economic justice icons, known ones like Emmett Till, Fannie Lou Hamer, Four Girls in Birmingham, 16th Street Baptist Church, Dr. King, John Lewis, Medgar and Merle Evers, as well as scores of unknown warriors who fought battles that we are still waging today. If the committee takes nothing else from my comments today, on behalf of millions of people of color, rural and persistent poverty, rural and urban communities, I implore you, I call on all of us that it's time to finish the job. Hope was established to build on this legacy to ensure that race, gender, and who one's parent may be, or where they're born, don't determine their ability to support their families and realize the American dream. Over nearly 3 decades, we've generated over $3.5 billion in financing for underbanked, unbanked homeowners, small businesses, other vital community infrastructure such as healthcare, education, rental housing, healthy food that are all necessary for a stable, vibrant economy. I want to share a bit about our experience as a Black and women-owned financial institution and how the resources provided by Congress added rocket fuel to our ability to support financially fragile people and communities during the health, economic, and social justice crises. During PPP, we made over 5,200 paycheck protection loans totaling 140 million. In a normal year, we make roughly 50 business loans totaling 40 to $50 million. 89% went to borrowers of color and half to women. Average loan amount was less than roughly $26,000 compared to $40,000, which was the national program average. In the process, we heard story after story from entrepreneurs who were turned down by institutions who had entrusted them to hold their money for many years. But we do more than just loan money. Many CARES Act programs managed by the states require local governments to expend funds up front for PPPs, firefighters, and other life-saving needs, and to later be reimbursed. This was impossible for many municipalities in places like the Delta and other persistent poverty counties. These places were dirt poor before the pandemic and even more devastated by the crisis. We structured with the Black Belt Community Foundation a program that advanced these towns up to $50,000 that were later repaid. In one town, the $24,000 was roughly half the town's annual budget. Would have been impossible for them to expend up front without reimbursements. We could not do this without the funds provided by Congress, the Rapid Response Program, the Emergency Capital Investment Program, the minority lending programs are all critically important. Using these over the next 6 years, we will double our consumer mortgage and small business lending and drive more resources into these communities. All CDFIs, however, do not perform alike. We see significant gaps in terms of who reaches the hardest hit communities. And so I encourage Congress to continue and increase funding for CDFIs in ways that are flexible and ensure accountability and transparency in how these funds are used. Given the outsized impact of minority depositories and reaching communities of color, Congress should drive resources to these communities and prioritize CDFIs and MDIs as partners in deploying federal funds to financially fragile communities. The efforts of Congress in the winter of 2020 represented an important first step to actually level the playing field in terms of closing the racial wealth gap. These actions have already saved lives and stabilized communities. They need to be sustained. I urge you to continue to make bold investments in organizations that do it best: mission-driven community development financial institutions and minority depositories, and we will bring other banks and credit unions into the fold along the way. In an increasingly diverse nation, we cannot leave the majority of Americans on the outside of the economy, withering away in opportunity deserts. Let's finish the job. Thank you so much for allowing me to share this with you today.
Thank you, Mr. Bynum. Ms. Elam, you are now recognized for 5 minutes to present your testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee, good afternoon, and thank you for this opportunity to testify on how federal support for MDIs and Cdfis have launched a new era for disadvantaged communities. My name is Nicole Elam, and I'm President and CEO of the National Bankers Association, the leading trade association for the country's minority depository institutions. A critical part of our mission is to advocate for MDIs and the communities they serve. MDIs are on the front lines of addressing the economic hardships faced by minority communities, serving consumers and businesses who are underserved by traditional banks. Decades of unequal access to capital, income disparity, and residential segregation have made communities of color the most vulnerable during a crisis. Yet and still, MDIs have been and continue to be best positioned to help our communities recover and overcome systemic inequity. The House Financial Services Committee and Chairwoman Waters have been instrumental in including several provisions and relief packages that have ensured that MDIs and the communities we serve are not forgotten. The Emergency Capital Investment Program and the $3 billion increase in funding to the CDFI fund will allow our institutions to scale up and provide more access to credit to individuals and small businesses. The bipartisan infrastructure bill also provides billions of dollars that can be instrumental in addressing our community's needs. The legislation included as part of today's hearing aligns with the committee's goal of preserving and protecting MDIs and Cdfis. These measures provide transformational opportunities for these institutions to not only survive, but thrive. We support each measure and look forward to working with the committee to ensure their passage into law, as well as continuing to work with you on additional legislation that will allow MDIs to continue to augment their capital bases, include our banks and communities and opportunities that flow from the infrastructure bill, and address a regulatory process that can hamper our banks' ability to bring the underserved into the financial mainstream. MDIs have served as engines of economic development in minority and LMI communities and have been significant providers of mortgages and small business loans, often saying yes when others say no. Their concentration in underserved communities and established relationships have made them a trusted financial partner. Our banks provide banking services to communities and racial minorities, especially Black and Hispanic, that are more likely to be unbanked and underbanked. Unfortunately, MDI's smaller size and historic lack of access to capital markets, especially among Black MDIs, has not allowed us to respond as quickly or with as much scale as the situations demand. MDIs only make up 3% of all banks, and Black-owned MDIs only 0.4%. Since 2001, we've lost nearly 60% of Black MDIs, and Black-owned banks only control 27,000th of 1% of total bank assets in the U.S. Tier 1 capital, or the equity invested in a bank, is the most critical component of the resilience of any bank, and it's what allows banks to grow and scale. Without sufficient Tier 1 capital, not only are banks limited in the number of deposits they can take in, but they're also hampered in their ability to withstand loan losses. Access to capital allows MDIs to not only respond better during times of crisis, but it allows us to reverse the economic conditions in our communities that are exacerbated during a crisis. The ESIP capital is a historic step in the right direction, but while 57 MDIs will receive $3.1 billion, many of our banks were not able to access ESIP due to prior regulatory challenges. This is largely based on examination standards that do not consider the unique business models many mission-driven banks need to employ to provide banking services in markets that would otherwise be ignored by traditional banks. We need regulators to be intentional and modernize the examination process for mission-driven banks. We also need to find additional ways to drive capital to ESIP ineligible banks and the communities they serve. For MDIs that were unable to access ESIP, we believe the remaining $300 million held in reserve for appeals should be prioritized for distribution to these institutions. In addition, we ask you to consider utilizing some of the remaining $1.75 billion in the CDFI fund. By prioritizing these institutions, we believe that Treasury and the regulators can balance their obligations to protect Treasury funds and at the same time insist these institutions operate in a safe and sound manner. We must act now to preserve and promote MDIs and direct much needed capital into banks that have a strong track record of serving the communities Congress intended to target for the ESIP investment. The bipartisan infrastructure law and a $29 billion provision in the proposed Build Back Better bill presents a generational opportunity to not only repair our nation's roads and bridges and to direct investments toward climate resilience, but to be inclusive. MDIs must be included in the financing opportunities that arise, giving our banks an opportunity, but more importantly, allowing us to connect minority businesses to these opportunities. Intentionally including MDIs in our customers will strengthen small businesses, create more jobs, and make our communities more resilient. The MBA again applauds this committee for holding this important hearing and for its ongoing efforts. While we commend Congress on its leadership to responding to various crises, we firmly believe much work remains to be done. The MBA looks forward to working with the committee on workable solutions, and thank you for the opportunity to testify. I will be pleased to answer any questions.
Thank you, Ms. Elam. Mr. Sands, you are now recognized for 5 minutes to present your testimony.
Thank you for calling this hearing and the role that Cdfis and MDIs play in providing access to capital to undercapitalized communities. I appreciate the opportunity to explore with you additional steps that should be considered so that Cdfis and MDIs can maximize their potential for delivering positive economic impact. My name is Everett Sands, and I have more than 20 years of experience in lending at MDIs at one of the largest national banks and the only Fintech Cdfi lendistry. For the past 6 years as founder and CEO, my focus has been on providing capital on responsible terms to underserved small businesses, and particularly those owned by minorities, women, veterans, and people in rural areas. Lendistry is a minority-led Fintech Cdfi, a community development entity, and member of the Federal Home Loan Bank of San Francisco, and a proud signatory of the Small Business Borrowers Bill of Rights. We are one of the nation's top SBA loan lenders in the $50,000 to $250,000 range, and more than 70% of our outstanding principal loan balance is with underserved borrowers. We also have a nonprofit technical assistance affiliate. Lendistry has been able to make an impact due to our focus on small underserved businesses, our partnerships with local and specialized organizations, and our proprietary technology and online application portal. Over the past 22 months, Lendistry has deployed approximately $8.4 billion in grants and loans to more than 570,000 small businesses, 94% of which employ less than 10 employees. And we expect that figure to grow to $10 billion by year-end. In addition to providing PPP loans in all 50 states, Lendistry has served as the administrator for relief grant programs in California, New York, and Pennsylvania, all of which were designed to ensure funds are distributed equitably across rural and urban regions alike. I commend this committee for acting upon COVID's era lesson. The small and underserved businesses are far and away more successful in accessing capital from Cdfis and MDIs. In response, Congress, with leadership from this committee, took decisive action to allocate significantly more capital to Cdfis and MDIs. Your work has provisioned the freight train of economic opportunity with capital. The urgent work that now remains for Congress is to enact a set of surgical repairs to the gaps in the track network that prevent the allocated capital from reaching communities more quickly, from having maximum possible multiplier effect, and to flow into more distribution points. My written testimony outlines 7 common bottlenecks in access to capital today. In the remaining time, I'll discuss 3 of those recommendations and briefly summarize the others. My first 2 recommendations are aimed at enabling Cdfis to make a much larger impact with the same amount of capital by bringing Federal Home Loan Bank's collateral policies for Cdfis in line with banks. FHLB should be required to accept any federally funded guarantee for small businesses, whether it's SBA, SSBCI, or others, as collateral from Cdfis. This change would have an enormous positive impact because when capital is funded by guarantees, capital can be multiplied, mostly on a 5-to-1 basis. So 1 million of capital can support 5 million in guarantee loans. This grows even further when you assume repayment. Another way FHLB's policies prevent Cdfis from maximizing impact of their capital is by assigning Cdfis a lower credit rating than banks, even though FHLBs have never experienced defaults from any member institutions. The lower credit rating has the effect of increasing Cdfis collateral requirements when borrowing from FHLBs and reducing Cdfis advance rates. The FHLB and FHFA should be required to assign Cdfis the same credit ratings as banks or create a loan credit enhancement fund to support the borrowings. The final bottleneck and recommendation I will elaborate on is the outdated state-by-state licensing requirement for Cdfis. A Cdfi licensing exemption will bring about 3 clear benefits. First, Cdfis can move much faster to deploy capital where it's needed. Second, Cdfis can easily attain risk management benefits of geographic diversification. And third, many more lenders will be motivated to attain a Cdfi designation. The effect of this would significantly increase the supply of capital provided on responsible terms, which in turn would crowd out predatory lenders and make those businesses less economically viable. To very briefly summarize the other 4 recommendations that are discussed in my testimony, they are to lower the minimum Cdfi bond guarantee from $100 million to $25 million, allow CDFIs access to the Federal Reserve discount window, develop an accountability reporting system for Treasury capital deployment programs, and create a federal office dedicated to supporting the efforts of MLIs. Thank you again to this committee and its staff for the opportunity to present my perspectives and recommendations. I look forward to engaging you further.
Thank you, Mr. Sands. Now, Ms. Orutia, you are now recognized for 5 minutes to present your testimony.
Good afternoon, Chairwoman Waters, Ranking Member McHenry, and members of the committee. Thank you for this opportunity. My name is Luz Urrutia, and I am the CEO of Acción Opportunity Fund, the leading CDFI providing access to responsible loans, coaching and support networks to underserved resource entrepreneurs. After spending my career in for-profit and nonprofit financial services, I have seen how small businesses make up the fabric of neighborhoods across the country and provide critical jobs, services, and support to their communities. Unfortunately, I have also seen how financial system has left behind so many entrepreneurs, people of color, women, and immigrants in rural and urban communities. To meet this need, Acción Opportunity Fund has deployed over $1 billion in small business loans and new market tax credit investments to underinvested communities since our inception. When COVID hit, we became economic first responders, using PPP to many thousands of small businesses, 60% of whom were people of color. We used the $1.8 million from the Rapid Response Program to deploy $10 million in loan capital as a result of increasing our loan loss reserves and further reducing our already low interest rates to provide entrepreneurs with critical resources. Acción Opportunity Fund did not just rely on government funding to support these entrepreneurs. We use this funding to leverage private sector capital, including a partnership with American Express, who committed $40 million in capital, which will be leveraged to deploy $125 million in loans to Black-owned businesses. This partnership with American Express was critical for business owners like Latrice, a Navy veteran, wife and mother of 3, who runs the digital solutions team, a tech support and system solutions company in Austin, Texas. She came to us after working with multiple lenders that did not offer her flexibility or the terms that would make her business successful. She used our $25,000 loan to hire a full-time operations manager and scale her business. As we transition to a life beyond the pandemic and the necessary crisis level response from the government, the questions for the CDFIs like us are, how can we translate the energy, the resources, and awareness of the past 2 years into long-term systemic and sustainable growth? How can we invest in these CDFIs and MDIs in non-crisis times so that they're equipped for the next crisis? Our answer is that we must collaborate and design industry-wide, bipartisan, market-based solutions that use the vast resources of the federal government to attract private capital so that we can scale with integrity and invest in CDFIs and MDIs to enable them to continue investing in our nation's small businesses. Examples of these collaborations are evident in 4 public-private partnerships that launched in the past 2 years, enabled by the State Small Business Credit Initiative, SSBCI. These new community lending funds were created to provide lower cost loans in 18 states and have the ability to transform the lending landscape for under-resourced small businesses across the country, bringing together government, banks, philanthropists, and CDFIs to deliver capital at scale. These funds have raised $350 million in private capital and have dispersed $204 million to 3,400 small businesses through a network of 25 participating CDFIs. 66% of the loans have gone to businesses owned by people of color and women. Entrepreneurs like Athea in Houston benefited from these loan funds as she went from being laid off from her job and started sourcing and selling Ghanaian waist beads, which are draped around the waist and connect Black women to their African diaspora roots. Athea used these loan funds to finance inventory, pay rent, and payroll as she opened a second location. I will conclude by sharing our deep gratitude for the many ideas we have seen from this committee, including your bill, Chairwoman Waters. Just to provide support for MDIs and CDFIs. The pandemic demolished small businesses across the country in a manner that fully unearthed our nation's racial wealth gap. And while CDFIs and MDIs were able to help provide for small businesses during this time, it is critical that the progress and momentum generated in the last 2 years continue onward. From maximizing the potential of the federal government's investment to leveraging these funds to attract corporate and private capital and building public-private partnerships, our organizations have moved full force in providing capital and support for under-resourced entrepreneurs. Much more needs to be done in the form of increasing CDFI and MDI lending capacity, encouraging creative partnerships in financial innovation, and clearing the way for full transparency in the marketplace. I thank the members of this committee in advance for working together to invest in and the support and resources to get this done.
Thank you very much, Mrs. Artia. Dr. Falkender, you are now recognized for 5 minutes to present your testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee, thank you for the opportunity to speak with you today on the importance of capital to our nation's businesses, as well as the broader topic of the current performance of the United States economy. I had the privilege of serving as the Assistant Secretary for Economic Policy at the Department of Treasury during the previous administration. In that role, I worked closely with the Small Business Administration to quickly implement the Paycheck Protection Program and ensure that the economic devastation that might have resulted from the pandemic was not realized. Part of my team's work was to engage with a vast array of lenders across our nation to ensure that eligible small businesses were able to obtain their PPP funds. I worked closely with CDFIs and MDIs to better understand the issues they were confronting and to prioritize resolution of challenges they and their borrowers were facing. Treasury also worked quickly to bring Fintechs into the program. Recent academic work by Sabrina Howell and co-authors finds that Fintechs disproportionately lend to minority communities with smaller dollar loans. Their smaller physical footprint and investments in underserved communities meant that they could more economically serve these populations and improve PPP access. In December 2020, Treasury worked closely with Congress on legislative updates to PPP, extension of a second round of loans for the hardest hit small businesses, and enactment of ESIP to provide additional capital funding for CDFIs and MDIs. The results of our efforts are apparent in the data. When the nation began shutting down, we were looking at weekly first-time unemployment claims of approximately 6 million per week. Quick passage and implementation of the CARES Act caused the unemployment rate to peak in April 2020 at just 14.7%, well below the 20% many feared at the pandemic's onset. Instead of losing 8 million jobs in May 2020, as many predicted, we saw more than 2.5 million Americans return to their jobs. My co-authors and I estimate that as many as 17.7 million fewer Americans were unemployed during the pandemic as a result of PPP, with nearly 13 million of those workers at companies with fewer than 100 employees. The pandemic recession has been declared the shortest in U.S. history, and we have been expanding since May 2020. While the funds deployed at the beginning of the pandemic proved vital in keeping us out of a depression and resulted in a V-shaped recovery once our economy reopened, challenges remain. All of us on the panel recognize that it is important for our nation's businesses to have access to the capital they need to operate and expand. ESIP provided the capital positions of CDFIs and MDIs, which will likely result in greater capital availability for their customers. However, while capital availability was a critical issue during the crisis, it is not now the primary issue confronting our nation's businesses. According to the most recent NFIB survey, just 3% of small businesses surveyed reported that their borrowing needs over the last 3 months were not satisfied. Instead, the NFIB survey reports that the main issues confronting our nation's small businesses are inflation and employment. Quoting their report, 22% of owners reported that inflation was their single most important problem, and 47% of owners reported job openings that could not be filled, end quote. Both of these problems are largely the result of poor policy decisions. Recent fiscal stimulus has proved greatly excessive, leading to household liquid funds rising from $11 trillion at the end of 2019 to $14.4 trillion at the end of the third quarter of 2021, which is a 31% increase. Simultaneously, paying people to not work, taking energy resources out of our economy, mandates that remove people from the workforce, and excessive regulations have greatly reduced our capacity to meet the current level of demand. The number of Americans working is still more than 2 million fewer than were employed prior to the pandemic. As a result of these factors, the Consumer Price Index was reported last week to have increased 7.5% over the last 12 months, the highest increase we have seen in the last 40 years. Even taking into account wage increases over the last year, this translates to an $800 reduction in annual purchasing power for the average worker. While we have seen a slight uptick in hiring over the last few months, arguably this is the result of the expiration of some of the pandemic-era policies that should not have been extended as long as they were. Since the expiration of enhanced unemployment benefits, job creation is approximately 50,000 jobs per month higher than prior to the expiration. The recent expiration of the child tax credit that lacked work requirements will also likely increase the number of Americans participating in the labor force. Such an expansion would be welcomed by our nation's employers, who, according to the latest JOLTS data, reported 10.9 million job openings at the end of December. While this committee's work to improve access to capital for America's business is important, the most important thing we can do for our economy right now is to declare an end to the pandemic and to reopen our economy. I look forward to participating in this important conversation.
Thank you very much, Dr. Falkinger. I now recognize myself for 5 minutes for questions. Ms. Elam, when the Paycheck Protection Program launched, at the onset of the pandemic, we saw mega banks prioritize their wealthy consumers, while smaller and minority-owned banks struggle to access relief. That is why I work to ensure MDIs and Cdfis could help deploy that aid to underserved small businesses, then later worked in a bipartisan way to secure $12 billion for MDIs and Cdfis. Since then, Senator Mark Warner and I organized an advisory group with leaders in the community development finance sector to ensure Treasury disperses these funds in the most effective way. To date, Treasury's Cdfi fund has distributed $1.25 billion in rapid response. And another 863 Cdfis have been helped. And we're now working on deploying $1.7 billion in a second Cdfi grant program. And of course, Treasury is also in the process of finalizing up to $8.75 billion in capital investments for Cdfis and MDIs. And although Treasury received almost, I guess, more requests than they were able to deal with, additional $4 billion is absolutely needed because of the requests that have been received for capital investments, and they will go unmet unless we're able to supply more money. Ms. Elam, how these programs helping Black banks and other MDIs and Cdfis serve their communities? As the funding flows to Cdfis and MDIs, do you believe the legislative reforms we're considering today, including a proposal to provide more capital investments and grants to address technology challenges, would be helpful?
Yes, resoundingly yes. You know, I think capital is certainly the number one issue that our MDIs have struggled with. They have declined in size because of lack of access to capital. And so ESIP, the funds that have gone to the CDFI fund are certainly things that are priorities. I think that the thing that we've been talking a lot about within our membership is that not all MDIs were able to access ESIP. And so having a round 2 of ESIP would allow those banks that at the time of application were ineligible to now be able to take advantage of those funds. We do not want to have a growing distinction between those that were able to access ESIP and those dollars and those that were not, because what happens is that it impacts those communities. On the second point around technology, that is one of the biggest issues that our member banks are wrestling with today. Technology costs money. They oftentimes don't have the personnel to vet those technologies. And so having grant dollars and capital that focuses on technology is certainly going to be helpful as these banks modernize and serve their communities.
Mr. Smith offered some recommendations regarding regulation that we may take a look at. What do you think about that? Do you have any other recommendations that you would like to offer?
Yeah, so I think one of the recommendations that I would like to offer is allowing some of those CDFI funds and allowing the second round of ESIP to be included for the ESIP non-eligible banks. Also, I think another recommendation has to do with the Bank Company Holding Act. You know, the 25,000 or 25% change of control provision really limits the number of investments that our small banks are able to get. So those would be two big things that I would prioritize, along with the examination process. We really need to do more to change the examination process. The examiners don't understand our banks, and as a result, they are negatively impacted during the examination process.
Well, thank you very much. And now the gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Dr. Faulkner, the Emergency Capital Investment Program, which is the focus of today's hearing, is but one tool that can be utilized to help spur economic growth. And so, in addition to that program, the Democrats later reauthorized the state small business credit investment initiative, the government sponsored investment initiative, in their massive spending bill enacted last year about this time. How effective are programs like those in creating long-term sustainable economic growth? Is direct government investment effective in narrowing wealth gaps, or do we need a broader approach?
Generally, sir, we need a broader approach because it's not just capital availability, as I mentioned earlier, that is confronting businesses.
So, you mentioned in your statement, and I mentioned in my opener about inflation. So tell us why the Democrat spending bill, like the one they passed last year at this time, are responsible for higher inflation.
Sure. So essentially, the outcome we see in our economy is the result of the desire of consumers and businesses to purchase things relative to their supply. And so what the bill does is it greatly increases the availability of funds for people looking to purchase things. So demand increases significantly while simultaneously taking supply off the table. So whether it's reducing workforce participation due to making more money on unemployment claims than by working, whether it's taking energy resources off the table, those things are going to expand demand, contract supply, and the outcome you necessarily receive from that is much larger inflation than we've witnessed for the last 40 years.
So more fiscal spending can't lower consumer prices, and a bill like Build Back Better would be the opposite approach that we need for lowering inflation. Is that what would you agree?
I would agree. We need to focus on the supply side constraints that we're confronting in our economy, not further buoy demand.
Okay. So the labor force participation rate is a critical measure of our labor market health. Up until 2 weeks ago, the percentage was at a near decade low of 61.2%. Now, talk us through what this percentage means. Why is the labor force participation rate important? What do we need to know about this?
Right. So the labor force participation is the percentage of adults who are actually either employed or looking for work. And if you think about what it takes to produce things, you need capital and you need employment. And so when a much smaller percentage of the American citizens are participating in the labor force, you're generating that much lower output that's then sold into the economy. So we took a lot of steps in the previous administration to see what we could do to raise labor force participation. We were at a multi-year high. We were at the highest level since 2013, just prior to the pandemic. And as you mentioned, we're still 1.2% below where we were. So there's still work to be done to get people back into the workforce.
So what this administration and what a Democrat Congress has enacted isn't helping the labor force participation rate or helping wages outpace inflation.
Right. So when people are paid more to not take employment than to take employment, that's going to tend to reduce participation in the labor force, even if it's not directly through unemployment benefits. But if there are not work requirements associated with generous social benefits, that'll tend to depress labor force participation. And so if we were to extend those things and make them more generous, you would likely see continued reduction in participation in the labor force. And
Okay,
that's
so
typically to be bad for
what are the
inflation.
right policies then? What are the right policies to get people back participating in the labor
So
force?
the policies that we followed prior to the pandemic were lower tax rates, less regulation, benefits that were tied to work requirements, and an expansion of domestic energy production, for instance.
So that energy tax is significant for working Americans.
Energy taxes permeate throughout the entire economy because transportation of goods and services are required in all sectors. And so it tends to multiply throughout all sectors.
Thank you for your testimony. And I think this leads to the case that committee Republicans are making, that we need a broader approach in these conversations. With that, I yield back.
Thank you very much. The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Thank you so much, Chair Lady Waters, for holding this hearing, and thank you to the witnesses for sharing your expertise with us. I've been an advocate and a fan of the work of Cdfis and MDIs. These institutions are able to effectively serve low and moderate income communities and communities of color at higher rates than their financial institution counterparts. Each year, on a bipartisan basis, I lead approximately 100 of our colleagues in requesting additional support for the CDFI fund's annual appropriations. And this past year, we were successful in securing an increase of $60 million over the previous fiscal year in the House passed bill. The CDFI fund provides resources for a range of innovative and effective programs through this appropriation that enable CDFIs to address the needs of their targeted markets. This committee knows MDIs and Cdfis are an integral part of ensuring equitable access to financial services. That's why we fought to ensure dedicated funds and boosted support for them in the various COVID recovery packages. I'd like to ask Mr. Bynum, can you speak to the unique role Cdfis were able to play in our COVID response?
Thank you, Congresswoman Maloney. CDFIs played an outsized role in driving resources into the most economically distressed communities, as you know. With the Paycheck Protection Program, initially CDFIs were excluded from that program. When Congress and the administration opened it up, we were able to drive funds to mom and pop businesses that are so vital to creating jobs for individuals who may not have the high level of skills or education, but are vital to stabilizing communities and supporting families. As I mentioned in my testimony, the average loan size of CDFIs that provided paycheck protection loans was for us was roughly $26,000 compared to $40,000 for the program overall. So driving it to those mom and pop businesses that are so vital. Initially, sole proprietors were not eligible for the program. We were able to broaden that and make that possible, which was critical. In addition, with the Rapid Response Program, that was a part of the appropriations that you passed, the program was able to reach loan funds, which were not a part of the emergency ESIP program, which are small, they reach small institutions, small loan funds that are critical in rural, persistent poverty areas and inner cities where there are not larger CDFIs and there are not banks. We saw how with ESIP, we are going to be able to more than double our lending to these programs. Some of the smallest businesses, nonprofits that provide critical support services were excluded from, we're not able to get in with very many banks through the PPP program, and CDFIs open doors to those institutions. So filling in the gaps, that's what CDFIs do well, particularly in rural, persistent poverty communities and communities of color, and for women, businesses, and families. Thank you.
Thank you. And as a quick follow-up, do you believe boosting annual funding for the CDFIs would help ensure a more equitable recovery long-term?
Absolutely. It is very clear that, in a normal year, in a normal environment, the programs are oversubscribed. The need is even greater now, even though some believe the pandemic is over. In the most hard-hit communities, that is certainly not the case. Families are still struggling, businesses are still struggling to get open, and they need investment that, unfortunately, in our region, with the SBA program, banks in Arkansas make 1.5% of their 1.2% of the loans go to Black residents in a state where the business population is 9% Black. The overall population is 14% Black. Banks are the primary users and drivers of SBA programs. And so relying on banks, unfortunately, has not gotten the job done. It is critical that CDFIs have the resources to step into the breach and fill the gaps.
Thank you, Ms. Elam. As you described in your testimony, MDIs do a great job of reaching minority communities at higher rates than traditional banks. Are there other ways Congress and government agencies can be promoting or raising awareness about MDIs and building on the work done so far today?
The gentle lady's time has expired.
Okay, I yield back.
Thank you. The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Inflation is a tax on all Americans and is at its highest rate in over 40 years. The rising price on everyday items continues to erode the household spending power for my constituents here in Missouri's 2nd Congressional District, and consumer confidence in our economic policies is at its lowest level since 2014. Dr. Faulkender, could you detail the fiscal or regulatory policy actions that help to create these price pressures on our economy?
Certainly, Congresswoman. So there are two major factors that are impacting the inflation that we're observing. First is that we've got an unprecedented level of money that flowed to households. As I mentioned, household balance sheets went from about 11 trillion in checking and savings account balances up to more than 14 trillion.
And this is from spending, from the government spending that was doled out. Is that correct?
That's right. That's right. So we've got very liquid households while simultaneously taking supply off of the market, right? So we've got reductions in oil, in energy production here in the United States. We've got the workforce is a couple million lower than it was prior to the pandemic. So you have this phenomenon where there's an enormous amount of demand that's built up during the pandemic with lots of money to go spend, and there's just not enough quantity out there to meet all of that demand, and the inevitable outcome to clear markets is much higher prices.
Well, and that's certainly, we're seeing that because demand is also been affected by the supply side, and the fact that our shelves are empty, and our supply chain is also in a very difficult situation on top of this, trillions and trillions and trillions of dollars in government spending. Can you explain the long-term effects of this kind of inflation and price increases on Americans, especially low-income Americans that we're focused on here today?
Right. So the thing about the price increases that we've seen is that wages have not kept up. So we've seen 7.5% increases in prices, but only 5.7% wage growth, which means that the average worker's purchasing power has gone down by nearly 2%. For those Americans who get almost all of their income from labor, from working, they are hardest hit by it. They consume a much larger portion of their income and their only source of income. They're not seeing some of the gains that others saw in financial wealth from the run-up in the stock market. So it tends to exacerbate some of the inequities that we had prior to the pandemic.
And Dr. Faulkender, during the pandemic, we witnessed the successes of public-private partnerships, particularly with the private sector financial institutions and their participation in the Paycheck Protection Program, which you spoke about in your testimony. Could you explain why these partnerships worked so well?
Absolutely. So I had the privilege of being one of the Treasury leads on the implementation of PPP. And to understand the success, it's to recognize that there are certain advantages that the private sector has. They have technologies, they have resources, they have know-how, they have relationships that the government does not have. And so what we did is we leveraged their advantages. We did the things that government needed to do. We provided them the resources, we provided them the rules, the structure, the forms, and then we let the private sector use its technology, its relationships to go out and serve the American people. And we saw that we were able to deploy the first 350 billion of PPP money in only 2 weeks as a result of that public-private partnership.
Right, absolutely. And I think our economy would be in a much worse position, and certainly the economic engine of our economy, which is our small businesses, would be in a much worse position had we not had that private-public partnership and the work that Treasury did to really work with this committee and others. Dr. Faulkner, can Cdfis and MDIs solely fill the need of the millions of unbanked and underbanked, particularly in minority communities and rural areas?
I'm trying to.
They can't. So, we have an enormous diversity in our nation, and the best way to service that diversity is to likewise have a diversity of institutions. And so, as we saw during PPP, Cdfis and MDIs stepped in to fill some of the gap, but so did the Fintechs. They likewise played an unprecedented role in serving historically underbanked communities. And there's been some academic work that shows the important contribution that Fintechs had during PPP.
I agree, and I'm out of my time, but I would say that Fintech firms really gave access outside of the traditional sources, especially to those unbanked and underbanked. So I thank you for your testimony, Madam Chairwoman. I thank you for this hearing, and I will yield back the remainder.
Thank you very much. Next, the gentlewoman from New York, Ms. Velasquez, who is also the chair of the House Committee on Small Businesses and who was instrumental in helping us to provide the $60 billion for small businesses after the big banks had ignored them. Ms. Velasquez.
Thank you, Chairwoman and Ranking Member, for this important hearing. And definitely, the data showed us that minority and underserved communities were left behind no matter how hard they tried to access PPP. And that is when we worked together, Chairwoman Maxine Waters and myself, to change that. So, Ms. Urrutia, Cdfis are a critical component of our nation's lending system, particularly for our smallest businesses in LMI and communities of color, which are often left behind by the biggest banks. As the chair of the House Small Business Committee, I directed additional PPP and other rescue resources to Cdfis and MDIs. How were you able to use the resources we specifically directed to Cdfis and MDIs to support small businesses in minority as well as rural communities throughout the pandemic?
To whom did you direct the question?
To Ms. Urrutia.
Congresswoman, she's not on. I can take that question for you if you like.
Sure.
So I think as CDFIs and MDIs, we recognize that small businesses were in a precarious position coming into the pandemic. And all of us tried to make our best decisions in order to react accordingly. I'd also like to just let you know, to just say that when you look at where we're at today, a pandemic doesn't always have to be a health emergency. As a study of economics at the University of Pennsylvania, we recognize that catastrophes can come in many forms. For example, in Congressman McHenry's questions, and he talked about the labor force, we do have somewhat of a pandemic epidemic coming, but there is a beacon of light. 4 million small businesses have been created during the pandemic. It would actually eradicate the labor shortages that were mentioned by Dr. Faulkner. If we can look at these businesses and we can help them and support them with capital, there's actually a unique opportunity here, very similar to the pandemic, where CDFIs, MDIs, and Fintechs, of which I find Lendistry is a part of both, could supply capital and could be very instrumental, not only in what we did in PPP, but we can repeat that today as we look at things like infrastructure bills and other opportunities. Thank you.
Thank you, Mr. Sands. And can you please discuss, can you explain how small businesses, particularly those that are women or minority-owned, often face an uphill battle in accessing credit on fair and responsible terms, and why are CDFIs and MDIs in a better position to serve those businesses?
Yeah, sure. Whether we like it or not, when you haven't had access to mainstream financing, it is very hard to build your business. It is very hard to be able to have the sophistication needed to get to the next level and to grow that business and therefore employ more people. CDFIs and MDIs represent a couple of things. Number one, a cultural competency that allows that small business owner to feel comfortable, an opportunity to build rapport, and an understanding of not only the historical plight of possibly that small business owner, but also the current plight. So if a woman executive from a CDFI fund, or excuse me, from a CDFI looks at a program for women entrepreneurs, she's going to have more insight on how to make that woman not only receive the proper business advising and technical assistance, but the correct credit products as she thinks about growing her business in ways that she could be successful. I believe that all the CDFIs that are witnesses here have been very instrumental in trying to make that come to the forefront.
Thank you, Mr. Sands. Mr. Sands, Senator Bob Menendez and I have introduced the Small Business Lending Disclosure Act, which will expand the disclosure requirements for small business financing options under TILA. Do you believe disclosures like the ones we are advocating for would enhance protection for small businesses and allow them to accurately comparison shop among lenders for their financing needs?
Absolutely, Congresswoman Velasquez. I think we all know that sometimes, even though there might be a language barrier, even there might be a reading barrier, what people have a tendency to understand is numbers. We've seen this in other asset classes, personal loans, mortgage loans, et cetera. When you introduce the numbers into the equation, what TILA does, and we are supportive of your bill, it then gives the borrower at least the option to make a decision, a credit decision, a financial decision, and the option to plan accordingly, which could be inclusive of maybe adding an extra $1 to the cost of pizza so that they can afford their loan, thinking about how they leverage their hours, thinking about how they renegotiate their rental contracts. There's a variety of different things that once you know the numbers, you're able to act more proactively.
Thank you. I yield back.
Thank you very much. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair. CDFIs and MDIs clearly play an important role in serving those in our communities who are both unbanked and underbanked. Republicans on the committee have routinely highlighted the importance of harnessing private sector investment in these communities while allowing for regulatory flexibility that does not stifle responsible innovation. Ultimately, this will provide greater access to credit, build financial security, and most importantly, create a more inclusive financial system, something I think we all agree on. Unfortunately, this has not been the current posture of this Biden administration. In fact, this past December, the director of the Consumer Financial Protection Bureau stated, quote, "Our largest banks have become bigger and even more powerful, while rural communities have become banking deserts, putting family farmers and businesses at risk," close quote. I can't disagree with that. And having literally the second poorest county in the state of Michigan in the 2nd Congressional District, which is a very rural district and rural county with a very heavy African-American component to it as a percentage of the population, we've seen this happening. And I would argue that it was over-regulation under Dodd-Frank that forced these small, often rural community banks to consolidate and merge before they eventually, oftentimes, many went out of business. And the Fed's own data supports this, noting in 2020 that there was 13,000 fewer banks in the United States than in the 1980s, with many of those closures occurring in rural areas. I will note that my Democrat colleagues would argue and do argue that we've never seen an economy like this. It's never been better. And we've got to celebrate this great economy. And their answer to that is, but we have to spend more money. We have to throw more money into the economy to continue this going. And I guess, you know, there's an old saying that when you're a hammer, everything looks like a nail. I would maybe convert that to say when you're an uber Keynesian economist Or maybe when you're a modern monetary theorist, everything looks like a spending opportunity. And that's exactly what we are seeing here today. In fact, despite well-recognized and agreed upon disparities, we don't have to look far in the past to see the benefits of full employment, which should be our goal here. And in 2017 and 2019, I want to make sure I've got these numbers right, Madam Chair, policies that supported free market helped raise the socioeconomic barriers for all Americans. No better example than this period, 2017 to 2019, when unemployment rate for African Americans was 5.5%. Hispanic American employment reached 3.9%. Asian American unemployment dropped to 2.5%. Collectively, the lowest levels on record in the modern era, literally. So we know what we can do to really truly narrow that socioeconomic gap, which is make sure people have opportunity and have the ability to go be successful. What we also do know is that inflation hits everyone, but disproportionately it affects lower income and minority communities. And that ought to be our goal, is to make sure that inflation is tamed. And I know my Democrat colleagues are frustrated that this side of the aisle often talks about what's happening, but we're percent inflation, folks. Wages have not kept up. The situation is dire for these on the lower rungs of the socioeconomic ladder, and it's our duty to go help them. And so, Dr. Faulkner, I want to, we've talked quite a bit about this inflation situation, and when I'm at home, constituents talk to me about it, and they certainly don't think it's transitory, as is oftentimes claimed. NFIB, the National Federation of Independent Businesses, survey their members, says that the main issues confronting our nation's small businesses are inflation and job openings that cannot be filled. So in my closing moments here, could you detail the fiscal or regulatory policy actions creating those price those price pressures?
Certainly. So labor force participation, as you said, is still rather low. We're a couple of million jobs fewer than where we were prior to the pandemic. So when we provide trillions of dollars in fiscal stimulus, that discourages people from participating in the labor force, particularly when there are no work requirements attached to them, when we take energy resources out of our economy, when we impose massive increases in regulation and constantly talk about tax increases, that's going to delay and deter businesses from expanding and hiring.
Thank you very much. The gentleman's time has expired. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agriculture Committee, is now recognized for 5 minutes.
Thank you, Chair Lady Waters. And once again, you're doing an extraordinary job, because I can't think of a hearing that is more timely. For as you know, many of our CDFIs and minority communities are going to be receiving millions of federal dollars very soon. And so I want to address my question to Miss Uruta. I hope I got that right, Miss Uruta. I'm sorry, I may have messed her name. What's her first name? Lopez, right?
You did good. You did good.
Oh, thank you.
Great.
Well, here is the situation. I want to talk for a moment. I think one of the keys, and you use these, they're called microloans. You familiar with those? Okay, I think they are very, very helpful with getting capitalization there, and they're pretty much manageable. First of all, I want you to expand on the importance of accessing microloans for the first time entrepreneurs. And microloans, as I understand it, are those loans that can be accessed, but they must be below $50,000. Am I right?
That's generally what microloans are described as. Yes, sir.
Okay, now, how do you feel about those? Do you agree with me that they're key?
Yes, absolutely. Microloans make a significant impact on the lives of a lot of small business owners that they need a very small amount of capital. What we've seen over the years is that, unfortunately, small business loans of this size are not really attractive to financial institutions for a variety of reasons. The loan is too small. The credit of the business is perceived to be risky. There's not enough profitability to make money because that small amount of money. But that does not mean that small businesses, particularly in this situation that we're in right now, where you have startups and businesses that really have lost a lot of their revenues, need small amount of capital to sustain. You know, a $10,000, $20,000 loan for a small business is equivalent to $1 million for any bigger business.
And so that leads to my other question. Why are these traditional banks trying to downplay these microloans when they've been so effective for beginning farmers? They can get the access that they need. Why are they many of them fail to help young beginners and African Americans because they say the loan is too much. They don't have the capitalization. But here we come with 50,000. And a small beginning business person can handle that. So I just wanted to kind of get a clarification on that. And I think you need to push more advocacy, explain how beneficial it is, because if we're going to shift out millions of dollars in federal spending, very shortly we're going to do that. We need to make sure that the primary vehicle, which is microloans, to get beginners started. They can get the loan, they can pay that, then they can go and get another one. So I just want to raise that issue and concern and hope that you will. And by the way, your story needs to be exposed even greater, because from reading about your story, you were an immigrant, you came over, you tried to get help, but then you went on and started your own business, and here you are trying to help the people that were in your situation. So let me commend you for that, but speak out and keep pushing these microloans. They're very beneficial. Thank you.
Thank you.
The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes. Mr. Hill? Mr. Hill does not appear to be on the platform. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chair. And full disclosure to our panel, I am a small business owner in rural America, and I can fix this whole thing. We cut taxes, we put more money in the hands of the banks, the people, et cetera, more and more startups, and we'll begin to see. So I think a lot of it's cutting taxes. But right now, I want to talk about inflation. Inflation is having a devastating effect on people all throughout our country, and people are seeing these prices increases at the gas pump, in grocery stores, and on their utility bills to heat their homes this winter. A recent report by Moody's and Analytics put a dollar figure on the massive inflation increase, and the average American is paying $276 more each month to simply live their lives. This is disproportionately harming low-income earners and people on fixed income who are having the most trouble absorbing these higher costs. So this is a drastically different reality than what we saw after we passed the Tax Cuts and Jobs Act in 2017. We saw wages outpacing inflation. The labor participation rate was rising, and more investments being made from small businesses. And it will not be an easy job to get inflation under control, but it is something that must be done if we're serious about helping our rural and undeserved communities. So, Dr. Falkenlander, can you discuss what you think needs to be done at the Federal Reserve and here in Congress to get us back to a high growth rate, low inflationary environment?
Sure. So on the fiscal side, I would suggest prioritizing incentives to bring supply back into the marketplace. So we've got 10.9 million job openings right now, and yet we're a few million jobs shy of where we were prior to the pandemic. There are a lot of American workers who are on the sidelines that can come back into the workforce to serve in some of those job openings. Second thing is that we need to make sure that we've got a tax environment that encourages both the businesses as well as the workers to participate in the labor force. Third, we need to bring our domestic energy supply back online. Fourth thing that we could do from a Federal Reserve standpoint is that we need to stop the accommodative monetary policy. We probably should have started pulling back on asset purchases a number of months ago and starting to raise rates. It looks like the Fed is now behind the curve, but Chairman Powell, of course, has indicated that there's some catch up to do. The problem is that many rate increases in a single year is going to be a shock.
Thank you. Secondly, something that helped propel the economy under former President Trump was the regulatory clarity that he gave the business community. I can tell you firsthand that was huge. There wasn't any uncertainty surrounding unexpected increased costs coming down in the pipeline. Unfortunately, this is not the case under President Biden. The American Action Forum conducted a study that showed in his first year in office, President Biden has already implemented over $200 billion, I repeat, $200 billion in new regulatory compliance costs on American businesses and small businesses, Main Street. These costs are amassed by an estimated increase of 131 million hours in new paperwork that must be conducted in order to be in compliance with all the new regulations coming from the federal bureaucracy. It's a disaster, to put it mildly. Banks feel a major part of this new regulatory burden. Instead of getting more money into their communities to finance job-creating entrepreneurs like we're talking about, they're forced to spend more money on compliance officers. These are sunk costs on the books and a drag on American innovators. So quickly, Doctor, can you discuss some of the pro-growth policies we should be focusing on so we can allow banks to get more money into the hands of Main Street America? And I've touched on one you have too, and that's cutting taxes.
So the other one you mentioned is regulatory clarity. So the problem with regulation is that there's what an economist would consider a large fixed cost component of it. So whether you have 5 workers or you have 50 workers, you have 500 workers, just bringing yourself into compliance requires updating your activities and your processes. The larger businesses have a larger scale to spread that across. And so a higher regulatory environment is naturally generally more advantageous to larger entities, whether that's larger banks, larger businesses, larger enterprises. So to the extent we want to spur small business entrepreneurship and we want to create an environment where small community banks can flourish, providing a less regulated environment that reduces their cost structure, particularly on a per worker or a per customer basis, is important as well.
Yep, lower taxes, less regulation. At the end of the day, it works for everybody, doesn't it?
It has wide-ranging benefits, yes, Congressman.
Thank you, and Madam Chair, I return my time back.
The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. MDIs and Cdfis, although smaller than many of their competitors, they play an outside role in communities with great demand for banking services. And these institutions provide crucial help in areas that would otherwise be banking deserts, and they provide more affordable products than alternative financial service providers. And that's why I'm so proud to have reintroduced the Ensuring Diversity in Community Banking Act, which passed out of this committee last Congress with a bipartisan vote of 52-0 and passed in the House as well on suspension. This bill strengthens many programs that provide capital to minority banks, creates a new impact bank designation for banks that predominantly serve low-income communities, and provides for a streamlined CDFI application process. So, Ms. Elam, can you speak to why these programs are so crucial to ensuring that MDIs and community banks remain an integral part of serving underbanked communities?
Thank you. First, I want to say thank you for your support of MDIs, for the reintroduction of this important bill. I think what this bill does is that it continues to preserve and promote MDIs, which is something that we're not seeing from oftentimes our regulators. And so not only does it focus on capital, but it focuses on making sure that they have the technology that they need to best serve their communities. Technology continues to be one of the biggest issues that our member banks have, whether it's cost, it's not having the capacity to vet those, it's the challenges with their core providers. And this allows them to grow and scale in a way so that they can begin to serve more in their communities. So this is certainly a hugely important piece of legislation. And we, again, thank you for that.
Thank you. And also technology is changing the landscape of banking as we know it.
Absolutely.
Whether it's financial institutions, including MDIs and CDFIs, are able to access and successfully leverage new technology can make or break their business model. And I think that's right. Mr. Sands, let me ask you, as the largest minority-led deployer of capital in COVID relief funding, Lendistry has proven that technology can enable institutions to better penetrate harder to serve communities. Specifically like in my state of New York, Lendistry served our small businesses by being the sole designated entity to administer the Small Business Recovery Grant Program. So I understand that you have a partnership also, I believe, with One United Bank, an MDI. So my question to you is, what are some of the challenges CDFIs and MDIs face when partnering with fintech companies, and how can Congress best ensure that such partnerships are successful and best serve consumers?
Thank you, Congressman Meeks. I think the first thing we want to look at is the narrative. And so the narrative should be that we support these partnerships, and the narrative should be that we encourage these partnerships, as you are already displaying. At Lendistry, we looked at helping underserved communities in a scalable way by thinking about two things. First, meet the borrower where they're at, make the process seamless, efficient, user-friendly, and accessible. Two, help our community-based partners level up and scale up their technology resources, leveraging our technology. As you mentioned, with partners like One United Bank and others, what we've been able to do is help them in terms of their scaling. Now, we do still have to get through processes like vendor management and other things like that. But I think the answer to your question is helping change the narrative that these partnerships are encouraged, both at a congressional level and at a regulatory level, and supporting these partnerships. As you know, there'll be some highs and lows as we go through this, but I think the end goal will see some scalable deployment of capital as we have in the state of New York.
So what would you recommend? Is there anything in addition to, I talked about the bill that we had, anything in addition there to that you think we should be doing in the United States Congress to make sure that we push that forward so that the technology is there and anything that we can do to be a further aid to create these partnerships and make sure they're secure?
Yeah. So you mentioned Congress and this committee have recommended things like technology grants and different things like that. While I understand that there's a bit of apprehension in terms of deploying more capital into our economy, I do think that we could take some surgical methods like focusing on technology, focusing on scale that are going to have long-term benefits. When we think about other things like cybersecurity and other obstacles that are going to come in the way long-term, I think there could be some laser-sharp focus on where those grants go. So the specific uses of funds will be extremely important as we think about how we lay out these different programs. Thank you.
Thank you very much. My time has expired. I yield back, Madam Chair.
Thank you. The gentleman from Tennessee, Mr. Kustoff, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you to the witnesses for appearing today. Dr. Faulkner, if I could, with you, you talked about the Paycheck Protection Program, and I think that Congress can pat itself on the back because that is an example of a bipartisan program that no doubt saved many small and medium-sized businesses across the country. And it really is a true benefit to say that that it's a successful public-private partnership. And I appreciate the role that you had from Treasury in setting that up and making sure it was a success. In your written testimony, you talked about fintech firms and how fintech firms went a long way to helping serve underserved or maybe underbanked communities. Can you discuss why that is? Why were fintechs so successful in helping those underserved communities?
Sure. So the major advantage that fintechs have, and I think a number of panelists have mentioned this, is that traditional banks have high technology costs coupled with the physical infrastructure that you normally have of providing branches. Fintechs are able to devote almost all of their capital resources, their capital investments towards the technology piece and scale that to serve communities that a geographic footprint often doesn't support. So particularly in rural communities, there's just not enough of a population close by to support a full-blown branch. Whereas if you can still serve the depository and lending needs of that community almost entirely through an online platform, you're able to achieve reductions in costs that can then be passed along to the borrower.
Thank you very much. If I can, I'd like to take you back to an article or a column that you wrote in The Hill back last year, I think in August of 2021. And you were critical of the Biden administration and the legislative agenda in terms of spending, and you predicted, and I think correctly, that added to or exasperated the inflation that we're experiencing today. And I guess my question to you is we're in a position now where the Fed is going to have to use the tools in its toolbox to try to combat inflation without hopefully triggering a recession. If I can with you, can you forecast what the Fed should do and what they can do, and in a way that it triggers, if you will, a soft landing?
Yeah, so the Fed's got a very delicate dance that it's got to walk, because on the one hand, with, as was mentioned earlier, 30 trillion in national debt outstanding, raising interest rates is going to pass that along in higher debt service costs to our nation, which is problematic. But at the same time, they can use monetary policy to curb some of the excess demand that fiscal policy has generated. And so they've got to try to find the balance where they bring down demand in order to reduce the increase in prices without putting us into a recession and without causing debt service costs for the nation to skyrocket to an unsustainable level. So part of that's going to be taking some of their accommodation in their asset purchases off the table. Some of that's going to be in the form of forward guidance. They're going to be probably more tolerant of inflation than they were a number of years ago, but they're ultimately going to have to raise rates and reduce the asset purchases, and do it very delicately, because we are in kind of a tenuous position.
So on that, I use the term soft landing. Can they do those things? Can the Fed do those things without necessarily triggering or forcing us into a recession?
Yes, it's possible, but if they raise rates too quickly, it will force us into a recession. But if they don't raise rates fast enough, we're gonna see this inflation continue. So they're gonna try to thread that needle. It's possible, but it's going to be difficult for them to do.
Thank you very much, Madam Chair. I yield back my time.
Thank you very much. The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair, who is also very grateful to serve under your leadership, and especially proud of the Small Business Credit Initiative, the state's program, because this is a $1,000 million program. $1,000 million for small businesses, and the program will generate $100 billion. So what I'd like to do is have Ms. Elam, Mr. Sands, and Mr. Bynum, in that order, explain to us the importance of this program that I was honored to have the opportunity to work with the chairwoman on, and it became part of the American Rescue Plan Act of 2021. Let's start with you, Ms. Elam. Explain the importance of this program.
Yeah, I think the importance of SSBCI cannot be understated. You know, pushing capital into the hands of small businesses is vitally important. We know many of the businesses that is going to receive this or be the beneficiaries of this capital are small businesses that maybe were already struggling and the pandemic exacerbated it. What I'm most excited about when I think about, you know, SSBCI 2.0 versus 1.0 is the focus on socially and economic disadvantaged businesses. I think the focus on those businesses is vitally important. And I think the push that you're seeing from Treasury to focus on utilizing MDIs and SSBCI 2.0 is vitally important.
Thank you very much. Mr. Sands, if you would, please.
Yeah, I will piggyback on Ms. Elam's comments. I think that it's really, really vital when we look at SSBCI 2.0. There's a huge opportunity not only for credit enhancements and loan participations, but also for venture capital. As we look at the 4 million businesses that have been started, as we think about things like inflation and some of the other tools that have been conversations that we've had here today, bringing these 4 million businesses into the forefront, letting them take the place of the workforce, letting them grow, letting them hire people, letting them raise wages. There's a significant opportunity. SSBCI will give lenders that moment or that tool that they can leverage in order to make some credit decisions that they might not make in a post-pandemic environment or in a normal credit market environment. And so we're very excited to see that, as well as see the equity go out in an equitable fashion, as Ms. Elam mentioned, related to the SETI requirements and also 10 employees or less. And I should also say there's a huge technical assistance requirement. So having technical assistance and business advising could be that momentum that we need to really take the businesses to the next level. Thank you, sir.
Well, thank you. But before I leave you and go to Mr. Bynum, let me ask you to elaborate on something else.
Yes, sir.
Let's talk for just a moment about the venture capital aspect of this in a bit more detail, because people hear that term, and I don't think they understand what it really means in terms of the difficulty in acquiring venture capital. Can you say just a word about the difficulty?
Yeah, so I think if we look at African Americans as a unit, roughly 16 trillion in GDP kind of flow, roughly 4.2 billion in VC capital. Those numbers are misaligned clearly. And so when we look at this opportunity, there's an opportunity for us to do 10 times leverage off the money, the venture capital money that's flowing through the SSBCI program. If we could have the forces of equitable capital deployment mixed with the right deployers of capital, mixed with it getting into the right hands, then when we look at things like how do we encourage businesses in rural areas, how do we think about bringing products back or manufacturing back to the U.S., or how we just think about overall expansion, it represents a very unique and significant opportunity for all of us.
Thank you very much. Mr. Bynum, you have a minute left. Please explain to us how important this SSBCI program is.
No, absolutely. I think Mr. Elam and Ms. Elam and Ms. Sands hit the high points. I will underscore how critical CDFIs are to driving resources to where it's needed most. In the first round of SSBCI, CDFIs outperform other distributors of SSBCI, driving almost half of their funds to low income, moderate income areas compared to 32% for non-CDFI lenders. And so that just underscores their importance. I think in the Deep South, it's important that CDFIs are engaged with states on the front end of the design. CDFIs were not involved previously, and we're seeing some positive momentum in Tennessee and Arkansas that leads us in that direction.
Well, I thank all three of you, and I especially thank you again, Madam Chair. This program has really saved a lot of small businesses, especially with what I'm calling the set-aside that's in the program. I yield back the balance of my time.
Thank you so much, Mr. Green. The gentleman The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Thanks for conducting this hearing. And let me begin by saying hello to my old friend, Bill Bynum. It's so good to have your wisdom and support here. We're so grateful for your leadership. Bill and I got to spend 3 years together on the CDFI advisory board at the Treasury during the mid-2000s. And Bill was a great teacher and educator as we collaborated there. And thank you too, Bill, for coming to Arkansas and serving West Memphis and Little Rock with your locations and beautiful College Station. So thanks for helping our citizens here.
Thank you.
First question, Bill, is thinking about all the new banks, existing banks that have been certified CDFIs. It boosts the numbers of people who are certified as CDFIs, but does it dilute the mission, given sort of your intensity of effort and that of our good mutual friend, Darren Williams, CEO at Southern, probably the largest CDFI in the region and the largest in our state. Does that dilute the mission when we certify all these other banks?
Congressman, thank you. I think it's important to, just like in any industry, all CDFIs are not created equal. Darren, Liberty Bank, some others, are doing great work in driving resources in a way that is consistent with the purpose and intent of CDFIs. However, we saw as the funnel opened up, a lot of banks were able to become CDFIs just because of their geography, not because they were driving funds into the most needed places like the Arkansas and Mississippi Delta. And we've seen that, in Mississippi, CDFI banks, when you look at the HMDA data, only lend at 13% to Black borrowers compared to 17%. Hope lends at 80%. So there are disparities, and I think there's some accountability that should be incorporated into the program.
Yeah, because I do like the fact that we spread the resources and the networking of the resources out, but there's also a real specialty that comes with this niche and commitment and vocational commitment to it. Mr. Sands, congratulations on your great PPP performance in the fintech industry. Thanks for that leadership. We had a lot of challenges with the SBA in that program, standing it up, but I think they, with some changes, delivered pretty well. But now I'm concerned about them suddenly displacing the banks and trying to replace the 7A program with a direct lending program. Do you support the SBA cutting the banks out of underwriting in the 7A program?
Congressman Hill, good to see you. I know as a fellow community banker, we probably got some similar thoughts. So I think there's definitely a fine line here. I think what we are seeing is that there are some smaller loans that are underserved and small businesses that are being undercapitalized. We do have to take that into consideration. And if SBA could help with that, I think there's an opportunity there. I also think SBA could help by bringing in additional lenders and focusing on other programs as well.
Well, let's talk about that and collaborate, because the EIDL loan program has been sort of, I think, helpful, but also a black box and a bit of a disaster in the pandemic. It's not really designed for an ongoing emergency. It's designed for a very short-term, weather or tornadic or hurricane type emergency. So I think there's a lot of need for reform there. I'd be eager to hear your views on that, as well as to make the 7A program more effective. Let's talk about reporting small business loans. I noted that there are 38% fewer CDFIs, despite my comment of the additional certifications. Still, the numbers are dropping, just like the numbers of small banks are dropping. Are you concerned that this 1071 small business data collection will actually cause more people to go leave the small business lending business, as it just adds too much cost?
No, I think one of the things that we actually recognize with PPP is that if we could have a streamlined, what I'll call formatting process and leverage maybe APIs, technology, et cetera, that we can get that information. I think it's critical, if I were sitting in your chair or in any of this committee's chair, to really understand the data that's coming in. Because if you're sitting there and you're in Arkansas and you're saying, look, I'd like to allocate resources or money to a certain place, it helps to just have the data to know where it should be allocated, right? Whether it's race, location, et cetera. And I think we have an opportunity with 1071 to get some of that information.
Well, I hope we can streamline it to make it a lot less costly for small institutions. Overhead to run a small institution is already overwhelming. So I thank you for your advice. Look forward to following up. Madam Chair, I yield back.
Thank you.
Thank you very much. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the subcommittee on housing, community development, and insurance, is now recognized for 5 minutes.
Thanks, Madam Chair. This is in some ways related to the questions that were raised by Mr. Hill. Maybe with a little different taste. Ms. Uratia, I have drafted a plan to introduce the CDFI Bond Guarantee Act of 2022, which has been attached to today's hearing. And the bill would make the bond program permanent, reduce the the minimum bond size from 100 to 25 million, and it would make a technical change requested by the CDFI fund. How would this bill help CDFIs such as yours? I'm saying if they are interested in participating in this program, and could you tell us how you might use these funds?
Yes, good afternoon. So our CDFI Acción Opportunity Fund does not currently take advantage of the bond program. We do find CDFI support to be very instrumental in helping us continue to deploy capital to under-resourced communities. So any type of program that can help us access capital and equity to scale our lending operation, we are in full support of.
So this program, just to be clear, this program, if we made this technical change, this program would be of significant value to you and to help CDFIs. Is that your?
Absolutely, yes. Any program that can provide capital access to CDFIs, which is part of our challenge, liquidity, accessing liquidity. And I want to go back because this SSBCI, I think it goes without saying that what SSBCI can bring to CDFIs is the ability to access liquidity and off-balance sheet leverage and resources so that we can scale our lending, which is really one of the limitations that CDFIs have today, because there's not sufficient capital. And because of the way that we're structured, where we have to raise equity via grants mostly, it becomes very difficult to continue to deliver the mission without having access to these programs that are leveraging private sector capital.
And let me follow up on the theme that you and I are having this discussion about. Historically, the limit on bond guarantees provided in the annual appropriations bill far exceeds what has been issued each year. The program has been authorized for 500 million annually since fiscal year 2017. But CDFIs have successfully accessed only a fraction of the potential of the program. It is particularly unfortunate that I'm receiving reports that smaller CDFIs and CDFIs in rural communities, I represent Kansas City, Missouri, but there are probably 30 little towns all around it. And I'm also adding communities of color and indigenous communities who would really love to benefit from long-term, low-cost capital, but they're unable to participate. Do you or any of the panelists object to making the bond guarantee program more accessible to CDFIs?
Yeah, I think one of the things that you find is that CDFIs sometimes are like small businesses. We don't necessarily know all the programs that are available to us to be able to access. So I think a recommendation from this would be for, marketing and information provided by the CDFI fund for all the different programs that are available, the purpose of each, and how can those funds be accessed.
Congressman, if I could add, I think the reduction to $25 million is critically important in getting the resources right sized to those smaller communities. They need projects, but they may not be 100, 200 million. And making it more available to CDFIs to drive funds in those communities is critically important, and it will allow us to leverage some of the other infrastructure dollars that are being made available by Congress as well.
Yeah, I mean, I think this has nothing to do with Democratic or Republican ideology. I mean, this is I think, a common sense kind of thing that would help communities large and small. I think my time has run out, Madam Chair. Thank you very kindly.
Thank you so very much. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairwoman Waters and Ranking Member McHenry for holding this hearing, and thanks to our witnesses for your testimony. I want to also express concern with what has been mentioned in the regarding the forthcoming cost of servicing our national debt. I'll note that JP Morgan expects 5 rate hikes this year. Goldman Sachs and Bank of America, are predicting 7 rate hikes. HSBC is predicting a 50 basis point hike next month, followed by 4 additional 25 basis point increases. Obviously, as has been noted, we have just surpassed 30 trillion in debt, and we need to get our fiscal spending on track and in order in this country if we're going to be able to support many of the programs that we need to have in place to assist historically disadvantaged groups and to make sure that every American has a chance to realize the American dream. As my time is limited, I also want to touch on some other topics, but before I get to that, Mr. Bynum, I appreciated the conversation between you and my colleague, Mr. Hill from Arkansas. And as I sit here at my home today in Cookeville, Tennessee, I know that we have a number of functioning CDFIs here in Tennessee, including one right here in my hometown of Cookeville, the Tennessee Rural Development Fund, and of course, Pathway Lending in Nashville and the Housing Fund in Nashville. And I wonder, Mr. Bynum, help me know, are these CDFIs in my home state and in my home community, do you feel like they're getting the job done? And what could I do as a member of Congress? What can our committee do? What can the Congress do to help them do the job that we intend for them to do if they're not already getting it done?
Thank you, Congressman. I am really glad that we have housing partnership. I mean, the Housing Fund and Pathways and CDFIs in Tennessee that are driving funds into rural parts of the state as well as in the inner cities in Memphis and in Nashville and Chattanooga. There are gaps that unfortunately small businesses and lower wealth families and entrepreneurs don't have access to. So you've got some strong CDFIs, and the work that this committee, this Congress has done to make sure that CDFIs have capital, flexible capital that allows them to do what they do well, really tailor resources to meet the needs of their communities, not have a one-size-fits-all solution, but sit down with businesses, with families, and make sure they're private bankers, they're financial problem solvers, which is what CDFIs do better than any financial institution. So thank you for supporting CDFIs and making sure they have the kind of capital they need.
Well, thank you for that insight, and I hope we might get the chance in the future to talk in greater detail. During the pandemic, regulators took important steps to provide temporary relief for community banking organizations who experienced unexpected and sharp increases in assets due to their participation in many of our federal coronavirus response programs, such as the Paycheck Protection Program. Unfortunately, in my view, that relief expired on January 1st, 2022. Regulatory compliance continues to be a burdensome, particularly for these organizations. Dr. Faulkender, I think this brings up a broader question. Should we be looking into permanently raising these regulatory thresholds for increased to allow for greater flexibility with these community banking organizations?
So generally, the capital requirements and regulations we place on community banks are probably excessive given the types of activities they engage in. We should not be thinking that they are mega banks and holding them to the same standards. At the same time, of course, we don't want to invite regulatory arbitrage. But yes, we should differentiate the environment we impose upon them from a regulatory standpoint based upon the activities in which they engage and how systemically important they are. We should not treat all of them, uniformly. We should recognize the differential business models they have.
Well, thank you. I appreciate the perspective, and I share that. And having served on the board of a small community-based national bank, I can tell you firsthand that unfortunately many of those regulations and that regulatory burden are what cause these small for-profit financial institutions to not be able to oftentimes meet the needs of emerging businesses and smaller organizations. So I share the view that we need to relax that standard and recognize the difference between our big banks and our small community banks. Thank you, Chairwoman Waters, and I yield back.
Thank you. The gentlewoman from Ohio, Mrs. Beatty, who is also the chair of the subcommittee on diversity and inclusion, is now recognized for 5 minutes. Ms. Beatty?
I'm sorry, can you hear me now?
I can hear you now.
Thank you, Madam Chair, for holding this hearing, and to all of our witnesses, thank you very much. First, let me just say, I would like to thank our distinguished panel of witnesses for being here today and for their testimony. My first question is for Ms. Elam and you, Mr. Byam. In your testimony, you cite the fact that Black-owned banks control 27 thousandths of 1% of total bank assets in the United States. In 2020, in the aftermath of the murder of George Floyd, dozens of companies, as you have witnessed, made public commitments to racial justice within the outside of their workforces. Netflix, for example, we all know that they were going to place 100 million of their assets in Black-owned financial institutions, and they followed through. So, Ms. Elam, what kind of impact would this have if more companies made similar commitments?
Thank you for that question. It's a phenomenal question, in that if you had more than a few companies doing that, but if you had 10s, 20, 30, 40, 50, hundreds of companies do that, you can certainly change the trajectory of these organizations, of these banks. There's been a lot of conversations around deposits and capital, but I think one thing that doesn't get enough conversation around is how are these companies integrating Black banks into the way that they do business? Are they integrating them into their financial services supply chain? When customers are swiping their credit cards, are they using our banks for merchant processing? So those are the things that we need to be focused on and talking about. So not only do we need more of them, but we need diversity in what they're doing. Everybody can't just do deposits. Everybody can't do equity investments. You need some of these long-term systemic revenue generating business opportunities in order to really change the dial.
Thank you. Mr. Byam, the Hope Credit Union received $10 million as part of this commitment. Can you briefly tell us the impact? Because I have one more question I'm going to try to get to.
Certainly, when you think of the region that we serve, a place like Itta Bena, Mississippi, where Mississippi Valley State, the great HBCU is located, we had all the deposits. We'd only have $1.25 million. So the $10 million from Netflix imports capital into these capital-starved communities and allow us to make more mortgage loans, more business loans, help make payday alternative loans that get people out of debt traps. So unfortunately, communities where you have such a dire wealth gap don't have the deposits to fuel their growth. And so deposits are important, as is equity. So it all goes together, and also contracts where they can buy from the businesses, and is something that we should also emphasize as well.
Thank you. Here's my last question, and I'll open it up with anyone that wants to talk about this. And I would, however, like to start with Ms. Elam. Here's the thing. This may sound a little self-serving. As you all probably know, I am chair of the subcommittee on diversity and inclusion. And this is something that's in the forefront of Congresswoman Waters and my leadership. Right here in the Midwest, we unfortunately don't have MDIs. And currently, there are very few in the Midwest and none in my great state. In my district, there is a group that have recently submitted an application for a banking charter that would now give Ohio, and right in the heart of my district, the first MDI. What resources are out there for persons or groups that want to form an MDI? What incentives are available for them? As a member of Congress, I have this unique opportunity to go talk to my community and say, here's what I fought for, and here's what the experts told me to do.
Yeah, so starting a new bank is certainly challenging. Not only is it capital that prevents folks from starting new banks, but it's also the regulatory requirements that can be onerous for starting a new banks. So at the MBA, what we try to do is we work. So when we've actually talked to that bank that is going to be starting in Ohio to learn best practices. This is what you need to know. This is what you need to be focused on when you're thinking about who's going to be doing deposits, because you want to have support from corporations. You want to have support from the state and local government. So who's going to be doing business with you? And so those are some of the things that at the MBA.
I hate to cut you off, but I have about 15 seconds. Is there anybody in particular? Should they call your organization?
Yes,
Should they
call the National Bankers Association. And we've already had a call with them, but they can certainly please feel free to call our organization.
And inclusive is the National Association for Community Development Credit Unions.
Okay, thank you so much. And I'll follow up with both of you.
Thank you very much. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. I appreciate this hearing, and it's timely that we talk about the consequences for all this spending that's gone on. So, you know, we don't want a federal government to exist. Our founders created one on purpose. It's defined by our Constitution, but we have a limited government. Right now, we're only talking about how much more government we should have, and unfortunately, there's not a way to pay for all the government that we have. We've seen the federal government's balance sheet grow to the point where we have 30 trillion in debt, and that's not even debt that we can have. That's not even debt that people lent us. The Federal Reserve's balance sheet has grown to over $9 trillion. So in a way, we've monetized it. How did all this inflation happen? You know, we monetized the debt, and I think that's really one of the big problems. And not only have we spent the money, and we spent it for things that were needed. You know, we spend money when there's a time of war, but you have to pay for it. The country realized that, and countries around realized that at the end of World War II. In fact, the last time that the planet had as much debt as the planet has right now was World War II, total debt as a relation to GDP. And at that time, the monetary system was reset. I wonder, Mr. Falkender, if you could talk about the consequences for debt and deficits, the importance of paying that off, and whether you believe that this concept of modern monetary theory or quantitative easing, where we don't even need a lender, we can just keep creating money, is that fact or fiction? And how will it turn out for people? And frankly, any implications for the wealth gap if we keep doing this?
Yeah, thank you, Congressman, for that question. We've seen other nations historically have debt to GDP ratios in excess of 100%. That tends to be where you see the financial crises take place. Right? So when firms have fiscal policies that are sustainable relative to their overall economy, they're largely able to avoid panics and inflationary bouts. Whereas when you see the kinds of debt that we are incurring recently and the urge to monetize it, then that's where you start to worry about inflation coming. So I think it's important to recognize that inflation is a combination of both a fiscal and a monetary policy outcome. So as I was saying before, the Fed's got its work cut out for it if it's going to curb some of the inflation we've seen recently. What we need is for fiscal policy not to exacerbate those challenges.
Yeah, thanks for highlighting that. You know, we think we spent $6 trillion just COVID related, not of any of the other spending, which we spend more than we can really fund in a normal process. But that 6 trillion didn't all go to GDP. What did it do? It inflated assets. And I would hazard to guess that as members of the committee, you know, we have more assets than most of our constituents. And so the wealth gap continues to grow. And unfortunately, the solution that I hear from most of my colleagues, frankly, is more government. And even when there is talk of taxes that would pay for some of the spending, the taxes don't even pay for all the new spending that you're talking about. There's no real cohesive plan to do this. I will say that it's a bipartisan problem. When Donald Trump was first president, he proposed a budget that balanced in 15 years, which was hardly aggressive, but at least it balanced. As we look at stare down a clock of funding that expires Friday, the 18th, there's only a plan to kick the can down the road till March 11th on the table right now. And my Democratic colleagues are just biding time to try to spend far, far more money than we have right now. It will hurt inflation. And I think the last thing I just focus on is, you know, benefit cliffs are dividing people in another way. Because when you do have inflation, the government policies don't catch up as much. And so that's another barrier to people participating in the workforce. So as my time expires, and I'd love to go into some of those, I just want to highlight a little bit of good news. You know, Mr. Sands, throughout the pandemic, fintech companies have really focused in minority and disadvantaged communities in my own area and rural communities. Fintech has really provided a lot of access to capital. Could you highlight how important fintech has been in the response to this current crisis?
Yeah, thank you for the opportunity, Congressman Davidson. I think fintech has definitely been able to show that we can go into places that maybe others can't. And when we look at places like rural United States, there's a huge opportunity for fintech to play a role. Thank you.
Yeah, thank you. My time's expired, and I yield back.
Thank you very much. The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair, and a big thank you to the panel for your testimony today and for all of you who are operating in challenged areas. Thank you for the work you did. You do. For many years, I worked in affordable housing, and it was really the Cdfis and MDIs that were serving the need in serving the need in some really challenged communities. So really have an appreciation for the work you do in Bridgeport, Connecticut, which I represent, and surrounding areas like New York City. I just have one question that I'd like to direct to Ms. Lopez Urrutia first, and then to Mr. Sands. And that question is, you've made a good case today for additional resources, for some things that we could do to ease your passage in the work that you do. I recall from my own days in and around this sector really being impressed by the extent to which particularly extending credit, but also even just getting people banked was an incredibly labor-intensive process. It involved a lot of close-in underwriting. It involved a lot more technical assistance, often to borrowers. You know, often you have first-time borrowers who require technical assistance that a more sophisticated borrower would not. And that always struck me as just a nearly insurmountable barrier to extending credit at the rates that we would like to do it. So my question is, setting aside everything that we've heard about the need for additional resources and other things today, what progress is being made in terms of upping the scalability? And Ms. Lopez Urrutia, I'd love to start with you. I have huge respect for Acción. My sister actually worked there for a long time. And I know that you're at the forefront of doing a lot of really interesting lending. So let me ask you for a minute and a half, and then I'm going to turn to Mr. Sands. What data science, technical innovation, what is out there that would allow us to do this very good work, but at larger scale?
Absolutely, and that's a very good question. Thank you for asking. Look, the CDFI industry, if we are going to scale, we have to employ a combination of technology and data analytics. I think the pandemic catapulted many of us to accelerate our roadmap for online and remote servicing to replace the face-to-face interaction. So almost overnight, as an example, most customer interactions across the country went to a digital platform, text, email, phone, instead of that branch and community-based locations that has traditionally categorized or represented the CDFI. You know, we believe that as much as possible, there should be technology involved for reaching businesses through different channels. So some people are ready to come to you online. Others want help that you can provide for them via phone or text or chat. So that's one piece, how you engage the customer. The other piece is how do you improve and get to a quicker response to a loan request? And that's very important because accessing our alternative data sources via APIs has gone up significantly. So looking at credit worthiness that extends beyond credit, because a lot of immigrants don't have credit or thin files, but they have bill payment and they have cash flows from their business. That is very important for us. And I do believe that CDFIs are starting to move in that direction, but it's a challenge because technology and investment in infrastructure and systems and people cost money. And so that's why we're looking forward to the bill that the chairwoman has introduced to provide some grant funding for CDFIs to be able to invest in this capacity to accelerate their lending and improve getting much more capital to under-resourced communities.
Thank you, Ms. Lopez. Let me give my last 50 seconds to Mr. Sands. Again, what can we do to increase scalability here?
Yeah, thank you, Congressman Himes. I think there's an opportunity to leverage kind of the tailwinds of social media, smartphones, et cetera, and kind of meet the borrower, the applicant where they're at. I mean, roughly a couple of decades ago, we would always talk about that younger user in the household who was translating or helping out or going on the computer and filling out. Well, that younger user is now our borrower. So we got some opportunity there. I think the other thing is to look at innovative products. You know, one of the things we're leveraging is leveraging bank statements as an ability to repay versus kind of traditional products where you say, okay, it's only a credit profile. Bank statements actually show ability to repay. Actually, I would say equally or better than the traditional credit model. The other thing I think we have an opportunity with Congressman Himes is to really take some of these technology partners and bring them into the fold, bring them into responsible lending. And that's why one of the carrots I think is out there could be a licensing exemption.
Thank you. Thank you. My time has expired.
Thank you.
Thank you so very much. And let me just say, I'm surprised no one has talked about incubators and what they could do to respond to what Mr. Himes is talking about. Now, the gentleman from Wisconsin, Mr. Stile, is now recognized for 5 minutes.
Thank you very much, Madam Chairwoman. Thanks for calling today's hearing. It's a really important topic that we're covering. Let me tell you, though, we've been staring at the screen for 2 hours. Personally, I cannot wait until we get back to work. People in Wisconsin are back to work. They're off the Zoom. They're getting it done in person. And so knock on wood, we're able to do that soon. But either way, big topic here. And I want to piggyback on what my colleague from Ohio, Mr. Warren Davidson, was commenting on with you, Mr. Faulkner, if I can. In particular, the inflation environment that we're in. You wrote a great op-ed in the Baltimore Sun. That was back when inflation was at 5%. We're now at 7.5%. When Chairman Powell was recently at the committee, I think about 18 months ago, I'll say that recently, I talked a lot about my concern about the monetary policy that we were doing, the implications that would have as it relates to inflation. We also have a fiscal policy going on in Washington where Washington continues to spend money like drunken sailors. And now we're in an inflationary environment. And I think one of the big things with inflation is it doesn't hit everyone equally. If you're a homeowner, if you own assets, inflation isn't good for you, but your assets inflate along with everybody else. But if you're not a homeowner, if you're a renter, if you are somebody that doesn't have significant assets, inflation's really clobbering you. And let me tell you, in Southeast Wisconsin, I hear it time and again when I speak with our lower income workers, when I speak to seniors on fixed incomes. And so we're here having, I think, actually a really good conversation about the importance of some of our minority depository institution, about community development work. Could you shine some light as to, with this really high inflationary environment we're having due to monetary and fiscal policies that are running amok, the unique impact that that's having at some of our MDIs and CDFIs?
Sure. So, Congressman, you raised a very important point that I should have distinguished earlier about how inflation is different this time than it's been traditionally. You know, we're operating in a 7.5% inflation environment while the Fed funds rate is at 25 basis points. And so think about that differential that's going on. You've got anybody who's in any kind of fixed income assets, anybody who's taking kind of a safer approach toward their investment profile and is only realizing less than 1% rates of return on their assets.
So that's our seniors in fixed income, a huge issue. But let's also talk about people who are struggling to get by. I think of a single mom sitting in Racine with 2 kids who doesn't own her home currently. She's renting. She's paying $800-900 a month, and rent's going up, and her wages aren't keeping up. How does it impact that type of a person that a lot of our MDIs are directly interacting with on a regular daily basis? Low-income workers in particular.
Right. So it's low-income workers who are hit in particular because they generally have less of a savings buffer to absorb the difference between the 7.5% price increases they're incurring and the less than that increase in wages. And so it's very much putting pressure on their budgets. They're having to cut back. When they can even find products that they're looking for, they're having to reduce their quantities of them. And so, yes, they're then reliant upon local institutions generally for some kind of assistance. And so, yes, it's important that we have a diversity of financial institutions that can serve these needs. And let me also just stress the role that CDFIs and MDIs play in financial literacy.
Yeah.
I think that's
so only cognizant of time, because this could be a great 5-hour conversation we're having, but I think it's really important. I think Congress needs to get our fiscal house in order, and I'd like to see the Fed get some of our monetary policy in order. But let's jump, because I had a great conversation. I serve as the ranking member next with Chairman Himes on the Select Committee on Economic Disparity and Fairness and Growth. And we held a hearing about banking the unbanked. And I think one of the most interesting things for me that came out of there was the percentage of Americans that now have a smartphone. And in particular, it doesn't deviate as much with race, according to a Pew Research, as it does with age. And so that study had that while 85% of Americans have a smartphone, it was 83% for Blacks and 85% for Hispanics. So a difference, but not a massive difference, if you will. And wondering if you could comment on how FinTech could really help us bridge the gap to the unbanked.
Right. So FinTechs bring down the cost of providing those services. You know, the best experience with FinTech arguably is overseas, where there's a much larger percentage of unbanked and underbanked and similar cell phone penetration. And so you've seen this shift in a number of developing countries to adopt cell phone-based technology to serve traditionally underbanked communities that we can call upon if we have
Mr. Faulkner, cognizant of the time, appreciate the dialogue. Madam Chairwoman, I will yield back.
Thank you. The gentleman from Colorado, Mr. Perlmutter, who is also the chair of the subcommittee on consumer protection and financial institutions, is now recognized for 5 minutes.
Thanks, Madam Chair. I'd like to get into a debate with Mr. Stiles and Mr. Davidson, but I'll start with a question that's on topic for you, Miss Aritia, or pardon me, Aritia. How do you say it? Aritia? Pardon me. Anyway, here it goes. In many cases, community development financial institutions are meeting demand of small and micro business lending demand where traditional financial institutions are not. This is a quote as reported by the Colorado Sun from a small business borrower in Colorado who worked with a local CDFI after being turned away from traditional lenders. They, the traditional lenders, didn't really want to take the risk. There just wasn't collateral in it for them to take that risk. I'm a female, I'm minority, I'm a veteran. I tried to pull every card I could, but traditional banks did not want to look at us. And then speaking of her positive experience, she said it wasn't just money. The Colorado Enterprise Fund, the CDFI, offered to help with marketing, offered to help with QuickBooks accounting, and offered to help with getting our business plan together to make it stronger. They just gave you more support. So, Ms. Arutria, what makes CDFIs more able to make loans where other lenders take a pass? Uh-oh, she's frozen on my screen. Would anybody else like to take a shot at that?
Sure, I could talk about it. I think the opportunity Cdfis have, or what Cdfis are leveraging, is both the intentionality of working with those who might not be able to be in the mainstream credit. I think the other thing that we've talked about here is programs like SSBCI, which give us an opportunity to take some of that risk and also leverage the opportunity to participate in a credit enhancement and others to have some innovative credit products.
So let's talk about that for a second, Mr. Sands. So, I mean, you or other organizations, can you come in and help a particular business or organization with their accounting? Can you give additional assistance beyond what would be traditional banking?
Absolutely, and
Do you?
we do. So we have a nonprofit affiliate called the Center, and we give one-on-one classes. Today they're via Zoom. They used to be face-to-face and Zoom, and also seminars. We teach everything from procurement, which is obviously a hot topic right now with the infrastructure bill, et cetera, to more specialization, which could be things like restaurant financing and different things like that. We also, sorry.
So let's talk about restaurant financing for a second, because Mr. Hill earlier said, well, we don't need the SBA anymore. We're really out of the emergency. In Colorado, we have a big hospitality industry. And Omicron hit the restaurant business again. Now we're coming out of it. It was a quick, sharp spike, but it basically shut down the restaurants from Christmas till a week ago. We're expecting half of our restaurants to fail. It's the one area where we're really seeing some trouble. So how can Cdfis and MDIs help the restaurant industry, and are you all doing that? So this is to the whole panel. Start with you, Mr. Sands.
Yep. So during COVID, what we talked to the restaurant industry about were insurance, how to handle their team members, how to look at their leases, other things that would be important that aren't exactly QuickBooks and how you borrow money, right? So we gave them that fortification and the understanding of how they want to move forward. Today, what we're talking to them about is, again, not only QuickBooks and financials, but we're talking to them about how they bring in the PPE, how they think about diversifying their business. It could be something like working with some of the DoorDashes and the Uber Eats and the different things to kind of modify their business, to getting a liquor license. So we're teaching them other things in addition to just the traditional financial principles. And they're very supportive of us helping them to grow their business. And we're also connecting them with other businesses. So if you think about the manufacturing within a restaurant, where they can get their goods and services and other things, that's also been very helpful for the restaurateurs that we've been advising.
Okay, thank you. And Madam Chair, I'd like us to have a hearing on inflation and the economy, because we've got a great economy. GDP's up more than it's been in 40 years. Unemployment's down, 6 million people added to the job rolls. Mr. Falklander, I can tell you, Peloton, they overproduced. They've got a glut of stuff, prices dropping. Purell, they've got a glut of that, prices dropping. So we're not in a typical scenario, and we got troubled industries like the restaurant industry. So this isn't an ordinary inflationary cycle. I've been through a lot of these. I'm a bankruptcy lawyer. I'll yield back.
Thank you. Thank you so very much. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for holding this hearing today. Dr. Falkender, I want to begin with you. What type of financial institutions were most effective in helping minority-owned businesses obtain PPP loans? Were there any noteworthy patterns that we as policymakers should take note of?
So in addition to Cdfis and MDIs that serve minority and underserved communities, the Fintechs really stepped up. There's some academic research that has come out demonstrating that where some of the traditional banks may have underserved those communities, Fintechs really filled that gap in order to help traditionally unbanked borrowers gain access.
Sure, thank you for that. Were there any trends in who MDIs and Cdfis provided PPP loans for? Existing customers, new customers, unbanked and underbanked? Again, I think it is important for us to examine what worked and what did not work, especially given that a significant portion of PPP funds were set aside for these institutions.
Yeah, so my recollection is that the Fintechs and the Cdfis did serve disproportionately minority borrowers. There were, at the same time, as I recall from the data, the very largest banks served their clients pretty proportionately by the end of the program. It was really some of the smaller some of the smaller banks that saw some of the shift from them towards the fintechs during the PPP program.
Sure, thank you. I think how PPP played out with MDIs and Cdfis should inform how Treasury administers the Emergency Capital Investment Program. But moving on to a different topic, but staying with you, Dr. Falconer, the White House seems to think that some of the economic data coming out recently is proof that their policies are working. Yet consumer confidence has not been so low since 2011, and GDP growth forecasts for the first quarter of this year estimate less than 1% growth. The president claims he has created millions of new jobs last year, but who in their right mind thinks people finally going back to the jobs they were forced to leave because of government-imposed lockdowns is job creation? These jobs, which are still a few million short of pre-pandemic levels, come back despite what the Biden administration and Democrats in Congress have done, not because of anything they have done, and now because of the extremely dovish actions taken by the Fed over the last year, coupled with the reckless spending we've seen in this past Congress. We are facing the highest levels of inflation we've seen in literally 40 years. 40 years. I did a little digging recently on how the Fed has responded to similar rises in inflation. I could not find an example in modern history where they successfully achieved a so-called soft landing and avoided a recession while simultaneously avoiding. We got problems. I mean, I don't want to keep going on, but consumers and business owners have seen the warning signs the last several months, but it seems my colleagues across the aisle in the Fed are just waking up to the seriousness of the situation. Hopefully it's not too late. Dr. Falconer, is inflation the primary culprit for the lack of confidence in the economy, or is it something else?
From the consumer sentiment survey that came out from the University of Michigan, they really pointed to two things. Number one was the Omicron variant, and then number two was inflation.
And what are your thoughts on supply chain challenges? I mean, I can't help but think that the fact that people in California were getting paid $900+ a week up until December 16th, they're just now getting back to work. We got lines of cargo ships in the Pacific. We got people that are being paid more to stay home. And it's no wonder that the shelves in South Carolina we're having trouble keeping them stocked. What role do you think supply chain challenges plays in the inflation that we're seeing today?
They play a significant role. So the pandemic itself is going to challenge the supply chain, but then when we have policies that then exacerbate those problems, then you get a delay in the realization of a return to normal. So when we have so when you shock one particular manufacturing location due to, say, the pandemic, that's going to already create a delay. But then when you have reductions in workforce participation, when you've got truckers sidelined, whether because they're making less working than they were being paid on unemployment, or because you impose vaccine mandates or some kind of other burden on them that reduces participation, that's going to further elongate the delay in quantity. What happens in the interim? Prices go up on the products that you can find.
Sure. Thank you for that. Madam Chair, I yield back.
Thank you. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Thank you, Madam Chairman, for hosting this meeting today. It's a very informative meeting. And because the way things have gone, one of the things I would like to say, I've heard many of my colleagues make reference to some of the spending that we did in this past year, driving up inflation. But one of the things I hope they realize is that if we hadn't spent a lot of this money, many of our businesses would be lost forever. You know, it was necessary that we reinvest in the economy to make sure that the economy could respond simply with this pandemic. My question to the panel, and any of the panel can comment on that, the ability to pledge small business loans to the Federal Home Loan Bank enables the lenders to make more loans with the funds borrowed from the FHL banks. Under the FHA Bank Act, only a small community bank under 1.2 billion and pledge small business loans to the FHA bank. Does it make sense to allow small banks the ability to use these loans to borrow from the FHL bank?
So Congressman Lawson,
Anyone from the panelists can respond.
yeah. Congressman Lawson, I brought this up in both my oral and my written testimony. I think we have a unique opportunity here for small banks, CDFIs, et cetera, to be able to pledge business assets. That's number one. I think there's another opportunity here to be able to leverage guarantees, SBA, SSBCI, and others. And then three, I think there's a third opportunity here as we look at the credit rating within FHFA that flows down to FHLB, in which CDFIs could be considered similar to banks, and or we can create some type of credit enhancement to make them feel more secure. We know that the FHLBs have never lost money, and we're not looking for them to lose money. What we're looking for is an opportunity to be able to leverage FHLB to provide lower interest rates and also more capital to undercapitalized communities. Thank you.
Catch a comment?
If I can piggyback on that, I think CDFIs, MDIs, particularly mission-driven CDFIs, should have full access to the toolkit of resources that are available to any bank. You know, we play an outsized role in driving capital, providing tools that help people climb the economic ladder. And we should not leave these critical frontline financial first responders with one hand tied behind their back. And so whether it's the Fed window, the Federal Home Loan Bank, SBA, CDFI should be a priority consideration as these programs are designed and have full access to them.
And just to kind of, yeah, just to double down on that point, I think PPP is the perfect example. You know, when you don't utilize small lenders or when they don't have set asides or access in a way that would be helpful to communities, those communities aren't served. And so what happened with PPP was that small businesses weren't able to participate in the program because those lenders that served them had challenges as well. And so any kind of way that you can make it easier for these small lenders to participate in programs is helpful.
Hey, Dr. Michael, I think Falkinger, in your analysis about inflation and where we stand now and the investment that the federal government made in order to stimulate this economy, do you think, from an academic standpoint, did we go in the wrong direction, or did it really help the economy to where we are today?
Thank you for that question, Congressman. I would differentiate between some of what we did early on in the pandemic versus what we have done more recently. So I think that you would have pretty uniform agreement that the $3 trillion that we spent on the CARES Act was absolutely essential, whether it was the various rounds of PPP funding, whether it was enhanced unemployment claims. You know, we were looking at a 32% drop in annualized GDP in the quarter in which we had the depth of the pandemic recession. We have been expanding since May of 2020. We have an unemployment rate that's been in the 4% range for a while. We have largely gotten our economy back open, and so we don't need yet another round of fiscal stimulus when we've already got an excessive amount of liquidity out there. What we need is for people to return to the workforce.
In your analysis, do you have any, I don't have much people saying, why do you think people are not returning to the workforce?
So I think part of it is that when they've got as much liquidity as they have, there's less reason to be in the workforce. When they're compensated to, when they're paid more on unemployment than they make working, they would also delay being in the workforce.
Madam Chair, I yield back.
Thank you very much. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Madam Chair, and let me say what a pleasure it is to be with you again, and thank the ranking member as well for holding this hearing, and to our witnesses, thank you for your testimony. I want to talk briefly about the work that our committee and the Biden administration are doing to uplift minority communities. As part of our second large COVID-19 relief bill, Congress included $9 million with a B, $1 billion for the Emergency Capital Investment Program, ECIP, or ESIP. And ESIP is historic, and it will be transformative for millions of Americans for whom access to capital is dependent on their MDI or CDFI. So I'd like to address some of your thoughts about ECIP. Mr. Bynum, your organization is a CDFI and credit union. So can you tell me what kind of impact the ECIP dollars will have on the communities Hope serves, and what does that mean in terms of support for your organization?
Thank you, Congresswoman. ECIP is a game changer for Hope and for other CDFIs. It took us nearly 14 years to grow to roughly $88 million. And in one injection, we're getting $88 million in capital that we can then leverage to grow to $900 million in deposits to drive into communities that are not, that have a much lower home ownership rate, where the businesses close at 40% compared to 20% for non-Black and brown businesses. We are working to use these resources to work with HBCUs, with small towns led by people of color, with inner cities, to help them leverage some of the infrastructure dollars and drive them into those well-starved communities that need more infrastructure, need affordable housing, that need healthy food stores, but don't have bank branches. And CDFIs are the only way that those dollars are going to get in. And then we can bring federal dollars and private capital from the Netflix, the Nikes that are providing deposits that we're leveraging with the ESIP to help to improve conditions and close these capital gaps that have existed for centuries in these underserved communities.
Well, thank you. As a proud two-time HBCU graduate, I certainly appreciate that. But let me ask you, in terms of a follow-up, do you believe that CDFIs that aren't banks or credit unions should be eligible for support from federal programs like ECIP? Why or why not?
Absolutely. There are many, many more non-depository CDFIs. And so we're leaving these vital assets on the sideline by not providing them with the similar type of equity capital that has fueled the depositories. These loan funds, these venture funds, these micro funds also need strong balance sheets so that they can go to the banks, the Bank of America, the Cities, the Wells Fargo, and Chase, and accept their debt. They don't give you grants at the level that we're talking about with ESIP. They'll give you debt, and you can't take debt without the balance sheet support. So it's critical that we inject capital into loan funds, into these small credit unions as well, that we're not able to get ESIP. They need more ability to leverage these funds as well.
Thank you. Let me get another question. Ms. Urrutia. So your organization is a CDFI loan fund, which was not eligible to participate in the ECIP program. So if Congress were to fund a similar program, do you believe that CDFIs that aren't depositors should be eligible?
Absolutely. I mean, the borrowers that we serve, they serve the same opportunities as those of depository institutions. And these small business borrowers really face the same challenges, no matter who they're going to get their financial services from. EC would clearly, or a similar program would allow us to offer extensive relief to small business owners, particularly those that have been most impacted by COVID-19, and further allow us to continue investing in low-income communities. I mentioned earlier that we got part of the $3 billion, we got $1.8 million, and we were able to leverage that to $10 million in capital to help 650 new businesses. And so this is very important, and we're pleased to be here today as a CDFI, having a seat at the table, being able to share the importance and the impact of our work that we do with underserved communities.
Thank you so much, Madam Chair. I'm out of time and I'm yielding back. Thank you.
Thank you very much. The gentleman from Illinois, Mr. Caston, who is also the Vice Chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you, Madam Chair, and I really appreciate all of our speakers taking the time today. I have, and I hope this isn't overly intellectual, but I have this sort of trouble in my head in thinking about MDIs and CDFIs. in the sense that we created these institutions to address, the lower levels of wealth and lower rates of wealth creation in minority and disadvantaged communities, which is good. But we also created the circumstances that created those lower levels of wealth, from racially preferenced subsidized loans, blockbusting redline, and of course the whole parts of our ugly original sin that predated that. And I don't share all that to go into a history lesson, but I find myself wondering when the issue that we have is that we preferentially subsidized equity, not racial equity, cash equity, and the accumulation of equity among non-marginalized communities in our country, is the best tool always to provide debt to the marginalized communities? And that's a big, meaty question. Like, I get it, but what I'm wondering, and Mr. Bynum, I'll start with you, is have you ever seen any good data on, relative to total wealth, how indebted are the communities you serve? And are there tools that we could provide to help get those communities equity that you don't currently have? And I realize that's kind of open-ended, but it's intentional. I'd love to hear your thoughts.
No, Congressman, I appreciate you driving there. And I think we got to really acknowledge, and I appreciate you acknowledging the history that had created these conditions. And it goes back generations. If you look at a map of where you had the highest concentrations of slaveholding and where you have the lowest housing conditions, worst education outcomes, worst, the fewest banks and the most payday lenders, they're largely the same areas. And so these are in places where you have the highest wealth gaps. 100 to 1 for a Black family with children compared to white families with children. And so layering debt onto them is not the solution. They need to be able to build equity, and home ownership and business ownership are the primary ways to accomplish that. Nothing closes those gaps more. And so Cdfis play a critical role in that. But right now in this still weak economy, and I appreciate that. Love to have a conversation about the state of the economy, but it is still very fragile in many communities. And so making sure that we don't just layer debt, but we layer flexible capital along with equity, and make sure that people have the ability to support their families and their children. It's a combination of tools. It's not just debt, but it is putting them on a path toward ownership and building assets.
And I guess what I'm wondering is, you at the end of the day, you're a bank, or you're going to make money by loaning to people. I would love to see a world where we have a set of rules where you have a greater incentive to give somebody a scholarship than you do to give them a student loan, right? Because one of those creates equity, one of them creates debt. I would love to see a situation where you have a greater incentive to help someone, get out from under PMI rather than give them a mortgage. And maybe that's a CRA reform question. I don't know, but where within your business model could we provide you with tools to give people more accumulation of equity in the first instance, given as, a lot of what I just described may feel more like charity than a business model?
No, and I acknowledge that our toolkit is limited as a regulated depository. Loan funds have more flexibility, but we are one piece of the ecosystem that is necessary to help these families and communities strengthen and climb the economic ladder. I also think it's really important to not vilify people for making smart decisions with some of these resources that have been made available to support their families. Full employment is an admirable goal, but we've got 70% of Black Mississippians who don't earn enough to cover basic expenses if they lose their jobs for 3 months. So full employment, if you don't earn a living wage, is not adequate. We need to help people earn more, build wealth. And again, we're a piece of the puzzle, but making sure that people have opportunities to build wealth is critically important.
Good. And Ms. Elam, I was hoping to ask the same questions of you, but this clock is counting down. So maybe we can follow up with you off the record so I don't eat into my colleagues' time. But thank you all for your time, and I yield back.
Thank you, Mr. Caston. The gentlewoman from Massachusetts, Ms. Presley, who is also the Vice Chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Thank you for convening this hearing, and thank you to our witnesses for joining us today. Our small businesses are what give our neighborhoods their character and our families their jobs. While it is not easy to run a small business, the sacrifice creates opportunity, freedom, and tradition as well. Chairwoman Waters and Chairwoman Velasquez have been delivering for small businesses for decades. When I was on the Boston City Council, I fought to lift the cap on liquor licenses so that for the first time in decades, new small locally owned restaurants could open in neighborhoods like Roxbury, Mattapan, and Dorchester. Unfortunately, decades of hard-won progress like this can be unraveled in an instant. As a result of the COVID-19 virus, those same small restaurants that nourish my neighborhood have struggled. I've once again found myself fighting for their very existence. With the rise in power and prevalence of multi-billion-dollar corporate companies, well-connected to financial institutions and products, Congress must be precise and intentional about investing in small businesses and Black-owned small businesses specifically, or else their doors will be the first to close and remain permanently shuttered. And yet, during the pandemic, many small businesses applied for and waited on PPP funding that never came. Instead, billions of dollars went to large corporations and chains, and an overwhelmingly majority of Massachusetts PPP recipients were white. Mr. Bynum, following advocacy from your organization and many others, certain changes were made to the PPP program to better engage Cdfis and MDIs. Can you describe those specific changes and how they benefited Black-owned small businesses in your network?
Yes, Congresswoman, thank you. First, it was opening up the PPP program to participation by Cdfis. We were not eligible in the first round, and the resources went to larger businesses, businesses that had long-term, large relationships with the banks, and ignored smaller businesses, smaller and sole proprietors were not eligible to participate in the first round. That was changed, which opened it up, and Cdfis outperformed banks, quite honestly, in driving capital into the small, into underserved communities and to minority businesses, rural businesses. So that was critically important. I think the lessons from that also fueled the other recovery programs that the rapid response and the ESIP, which are driving resources more to mission-driven Cdfis. And I'm glad that those lessons are being applied. All Cdfis aren't created equal, and so making sure that you get the frontline institutions like minority depositories, community development credit unions, loan funds that are small but powerful in driving these resources has been critically important, and I hope we continue that going forward.
Thank you, Mr. Bynum. Again, grateful for your advocacy and that you raised your voice, and even more grateful that our chairwoman, Maxine Waters, listened and heeded those calls and fought for those changes to be made. Certainly, Cdfis and MDIs are powerful opportunity builders. One barrier to receiving the financial and technical support for our Black-owned businesses that I've noticed is a lack of awareness of the resources that are available in the first place. It's not true if you build it, they will come, if they don't know about it. So specifically those made available by our Cdfis and our MDIs. So Mr. Bynum, if the Cdfi fund made easier for individuals, small businesses, and communities to locate Cdfis and MDIs, do you think that that would help Black-owned small businesses?
No, absolutely. We are, one of the things that we've seen is that Black banks, Black credit unions have shrunk dramatically over the past decade, following the financial crisis and increasingly. And so it is essential that we stem that tide, and the Cdfis programs are critical in making sure that happens. And it is not going to happen if those resources are not targeted in a way that benefits the communities that are hardest hit, that are most financially fragile. And so that's, again, small loan funds, small credit unions, minority depositories, I think should be considered as priorities in investing Cdfis and federal resources as we continue to climb out of this economic crisis.
Thank you, Mr. Bynum. And to the point that I raised a moment ago in terms of, getting the word out to any of the witnesses who would like to expound upon that. Are there ways that Congress and government agencies can better raise awareness about CDFIs and MDIs and capital and technical assistance that they provide?
I think that
Unfortunately, the gentlewoman's time has expired, but we'd like you to get back to her directly with some responses to how to get the word out. Thank you. The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, for this hearing, and thank you to all the experts who are here with us today. This has been really enlightening. In the CDI space, what I wanted to talk about is an area I think does not get enough attention, and it's the important role that CDFIs play in providing financial and technical assistance to people with disabilities. People with disabilities face a range of financial challenges, often encountering barriers in securing traditional financial services. According to the National Disability Institute, the percentage of unbanked households is more than 3 times higher for households with an individual with a disability. When you also consider race, the numbers are even more staggering. 17.8% of Black households include someone with a disability, and a full 28.5% of those households are unbanked. Moreover, according to the National Disability Institute, over 20% of households with a disability have an unmet need for basic credit. Given the financial challenges faced by households with a disability, CDFIs have a vital role to play. Given the importance of CDFIs for ensuring people with disabilities have access to credit, I have fought for targeted CDFI funding for financial and technical assistance for people with disabilities through something we have here in Pennsylvania, the Pennsylvania Assistive Technology Foundation. Mr. Bynum, Mr. Sands, Ms. Urrutia, do your organizations have experience lending to people with disabilities? Can you speak to the importance of CDFIs in this space? How can we do better, and who's being left behind?
Just 2 points, a couple of points I'd make. Yes, we do. And it also speaks to the point of CDFIs as part of ecosystem. We partner closely with other organizations that provide appropriate assistance that's culturally appropriate, that targets the needs of those communities that we're trying to serve, including the disabled. And the access to flexible capital is critically important, because you cannot, again, as we were talking earlier, layer unaffordable debt that these families cannot sustain, given their particularly fragile financial position. You've got to make it stretched out. You've got to make it work for them. And so a combination of debt and equity and grants are necessary. So flexible capital allows us to put the tools that CDFIs have to best use.
Mr. Sands, did you want to add anything, or Ms. Urrutia?
Yeah, I would say we're doing similar to what Mr. Bynum said. I'll just add a couple extra things. We also adjusted all of our online applications so they would have accessibility. As you know, that's a big tool whenever you're trying to go online and you're trying to leverage or be able to make a web tool or technical application a little bit more accessible. The second thing we're doing is we're monitoring the data in which those who mark themselves as disabled, where they might be struggling with an application, so that we can make our system more fluid for them. And then the final thing I'll say is that we also introduced some online education tools, which we believe are going to be pretty expansive in terms of getting the education out. Again, leveraging cell phones, which we recognize that these individuals do have for a variety of tools that they're obviously using as basic services in their own lives. Thank you.
And Ms. Urrutia? Some of the same, plus we have launched a call center that is available 7 days a week, 15 hours a day, cross times, with bilingual customer care and ability to offer support in other multiple languages, and then one-on-one coaching directly through partnerships that work with the community. So for us, it's continuing to evolve. We believe technology and flexible capital, which Bill spoke about, are going to be key drivers in better supporting the community. Thank you. And maybe any one of you who would like to answer this. As the COVID-19 pandemic continues to evolve, still many small businesses have yet to recover. In your work, how has small business lending changed during COVID-19? Again, who has been left behind? And I say this knowing that I'm proud that my district has the most number of small business employees in all of the Commonwealth of Pennsylvania. Would somebody like to give 10 seconds to that? Sure, I'll start. Underwriting has evolved significantly. Credit scores are no longer what they used to be. They don't give us the view of the future. They only tell us about the past, and we know the past is very different. And we see how additional data sources and technology-driven solutions have become significantly more important for small businesses and access to flexible capital. Thank you all. Thank you. I yield back.
Dr. Lady's time has expired. Thank you very much. The gentleman from Massachusetts, Mr. Auchincloss, who is also the vice chair of the full committee, is now recognized for 5 minutes.
Thank you, Madam Chair. I wanted to ask about incubators for small businesses, which are designed to help businesses in their earlier planning stages. And Congress, as I'm sure our witnesses know, is having a growing interest in small business incubators, including $1 billion in funding to establish uplift incubators to help entrepreneurs in underserved markets. That is included in the Build Back Better Act. Lendistry and Axion Opportunity, you participate in lending to small businesses, including in using SBA financing. Have your companies, either of you, had the opportunity to work with incubators or entrepreneurs in underserved communities that are members of incubators?
Yeah, I'll go first on this one. I think we both had, but we absolutely have. And the way we tend to look at this, Congressman, is we look at this as there's a continuum of capital that we must make sure that the small business has. And so while I would say, I'll speak for Axion Opportunity Fund, is more focused on kind of micro lending. We're looking at that next stage of capital. And the game plan is not only in technical assistance and business advising with the accelerators offer, but also thinking about that capital path so that they could be job creators as well.
Yeah, I would just add that when you look at a lot of the startups, they do not have revenue to demonstrate their ability to pay loans. And so we always say that a loan is not a replacement for revenue. And what many of these businesses that are smaller, the ones that we work with, is they need equity, but there's really not a fully developed equity market for the type of businesses that we're talking about here. So in the situations, we try to work with them to find grants, and those are hard to find, but there needs to be a better developed market for equity capital for these small businesses that have a longer term view as opposed to a view to get a liquidity event.
Yeah, that must be challenging because unlike in the venture software industry, for example, where there's sort of the potential for uncapped upside, and so equity is an attractive investment. For a small business incubator, that's got to be a more challenging market to set up. Do you have any advice for Congress as we look at these uplift incubators for how we can attract equity, knowing that this is for small businesses?
Yeah, my suggestion would be some of the things that you've already put into place as you think about procurement, Build Back Better, and you think about the infrastructure bill. Naturally, we know that minorities have a tendency to focus on service-oriented businesses. However, I think there's also opportunities for them to expand beyond leveraging either technology resources that you somewhat described, but also opportunities for larger contracts where they can get bonding, insurance, et cetera, that these accelerators are also helping them with. I think the ability to grow revenue overall will lead to more VC money. And so if we could find ways to get them into components which drive revenue or opportunity for revenue, I think there's some huge opportunities there for the capital to flow accordingly.
Yeah, and to be clear, I mean, the goal is for a lot of these businesses is not necessarily VC investment. That's a very specific niche type of business. And we want a whole flourishing ecosystem of small businesses, some of which are service oriented and aren't going to have kind of either venture scale chances to fail, frankly, but also venture upside. And that's perfectly appropriate. It's both of you have emphasized that customer acquisition is really the key. Loans and grants are great, but they're not revenue. What is the procurement help as with the government as a customer makes a lot of sense to me. Are there other important ways that small business entrepreneurs in underserved communities can get help in accessing those first couple of key customers that you've seen really work?
I think if you double down on the strategy of having government contracts be accessible, speedier pay or faster pay when a government contractor is available. I'd also encourage you to look at the SBIC program. There's been some conversation about making that a better entry process for CDFIs, mission aligned, venture capitalists, et cetera. And I know I'm using the word venture capitalists, but just generally investors. And I'll pause there in case Luz has anything to add.
Yeah, the SBIC program at the SBA, I believe, already does that.
And what about, in a previous hearing we discussed, and I had raised the accounts receivable payback time from the federal government. Do you ever hear any of your businesses complain about the amount of time it takes the feds to pay their bills?
In a simple word, yes. But I do believe that there's been some great progress lately in that.
Madam Chair, I yield back. Thank you.
Thank you very much. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Madam Chair, for this important hearing today, and thanks to all the witnesses. 26th Street in the neighborhood of Little Village in Chicago is one of the most vibrant commercial areas in the country. Small businesses, restaurants, beauty salons, grocery stores, bars, primarily owned by immigrants, sustain a rich economy. But when the COVID-19 pandemic hit, even strong businesses that have been around for decades were worried. Many didn't have relationships with existing banks or the Small Business Administration. And that's where CDFIs like the Resurrection Project and Allies for Community Business stepped in. CDFIs and MDIs have proven their value. They strengthen and promote economic opportunity for underserved working class communities like the ones I represent in Chicago and Cook County. They were a lifeline to immigrant small businesses when disaster struck in 2020. So it's imperative that we make the necessary investments to support these institutions that are vital to helping families recover and prosper in our economy. Ms. Lopez Urrutia, during the COVID-19 pandemic, Latino small businesses were hit particularly hard, and we know they could not access PPP funding at the same rate that other business owners did. Clearly, more needs to be done to reach the Latino community. I heard it every day in my neighborhood. Do you think traditional lenders did a good job in providing Spanish language access to businesses during the COVID-19 pandemic?
You know, I think that every financial institution, large financial institution, many of them announce that they have servicing in Spanish, but it's really very basic. I think that the recognition that, you know, the Latino community is rapidly growing, and it's, you know, one of the fastest growing populations in the US, and, you know, Spanish speaking populations in general are one of the most underbanked communities in this country. You know, our roots, we are headquartered in California, and so our expertise lending to Latino-owned businesses goes back several decades. And what we have found is that the service and what Spanish-speaking customers need, you know, span all the way the spectrum of lending products, technical assistance, and how to. And so we have, as a result, launched, you know, I mentioned a call center. It's open 7 days a week in Spanish to help customers through the entire application process, provide supportive coaching, webinars, and technical assistance in their language, because that's how they feel comfortable interacting, and that's how you get to build trust with the community. So I think that's a very important component for anybody that's going to address this community, to engage and have culturally competent engagement actions with the community.
Thank you for that. Mr. Sands, how can how can the Small Business Administration be more responsive to businesses that don't have a traditional banking relationship? And do you think that changes that Congress made to broaden access to PPP loans will have permanent benefits?
Yeah, absolutely. I think, thanks for the question, Congressman Garcia. I think that essentially, Congress has always had this army of mission-based lenders. And the mission-based lenders, as you heard Mr. Bynum say, have kind of fought with one arm behind their back. Any PPP was one of the first times where there were changes made in policy to allow for them to have full deployment, whether it be the PPLF facility, some changes in SBA, the ability for us to lend nationally. These are things that I think we have an opportunity to not wait for the next pandemic and to keep moving forward on. In addition to Congressman Cleaver's bill in terms of lowering the CDFI bond guarantee entry level. I think there's many, many opportunities here for Congress to say, let's look at what was successful and let's continue going, regardless of whether or not there's a pandemic.
Thank you. And Professor Falcon there's no question that inflation is a challenge to our small businesses, but raising the interest rate can have unintended consequences. If we slow down our economy and my neighbors have less money, small businesses will suffer too. Mr. Falkland, when the Fed raised interest rates in the past, what impact has this had on small businesses in working class communities like mine? And has it hurt their ability to borrow? And you're going to run out of time. I've got about 15 seconds.
Right. So there's a trade-off to raising interest rates that you're going to benefit savers, but anybody that's in a credit position is going to pay higher costs for it. But to the extent that price stability is an important mandate of the Fed, it's important they use their tools to keep prices in check.
Thank you, Madam Chair. I yield back.
Thank you. The gentlewoman from Texas, Ms. Garcia, who is also the Vice Chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you all to all the witnesses. I know it's been a long hearing, but the end is in sight. We are near the end of the questioning, and it's always really great to see people who are so willing to be here, interested in providing so much information, because I have really learned a lot today. Madam Chairwoman, it is important to make note that low-income Latinos are disproportionately impacted by inequitable financial system. The FDIC estimates that 30% of Latinos, many of whom are Spanish speakers, don't have a bank account or use alternative financial services. Lots of community banks have already adopted practice that make it easier for Spanish-speaking populations to use bank products. For example, many of them do employ bilingual staff, or they translate materials in Spanish. However, adopting this program is not enough, and is a great first step, but we need to make sure that they also get into really planning and give some careful thought to how they do this for our Spanish-speaking community, and frankly, other communities who have language barriers. The Technical Assistance Program with the CDIF fund is a perfect tool to ensure that grant recipients have the resources they need to thoughtfully set up language barrier services. Bolstering the Technical Assistance Program to include trainings and resources could build upon CDFI's existing capacity to serve Spanish-speaking populations. Ms. Garcia and Ms. Ilam, my question to you is, you heard my compadre, Mr. Garcia of California, Chicago, talk about some of these barriers. You know, it's not enough to just go to Google Translate and translate materials if people go home and don't really understand them. Or some banks and some companies, you know, provide the loans, but there's somebody else who services the loans who then starts sending them everything in English. So what could we do more in terms of the technical assistance, in terms of funding? And can you be specific of what else people should be doing other than just providing materials in Spanish?
Sure. So just to comment on the technical assistance program offered by the CDFI fund. We do not apply for it. It's a very small program. We apply for the financial assistance program award, and you cannot apply for both. The technical assistance, I believe, is $125,000. But I think that the most important thing here is that these awards need to be allocated more proportionally according to the organization size and the impact and the value that they bring to the communities. Lending and technical assistance, for example, CDFIs that have drastically different portfolio sizes generally are awarded the same amount of CDFIs in the financial assistance program and the technical assistance program. So it would be prudent and really more impactful to allow for more funding to organizations that really wish to scale their lending and or their technical assistance, and can provide projections and prove portfolio and customer growth. To your second question about what can be done, it is the trust needs to be built by getting to know the customer. Not every Latino customer is created equal. They all have different situations and circumstances and needs. And I think it's incumbent for any lender or provider of financial technical assistance to really meet the customer where they are and to be able to design specific solutions, products, and coaching that meet the needs of that business owner at that moment in time.
Ms. Long, would you care to add anything?
Yeah, I think Ms. Urrutia hit the nail on the head in terms of knowing your customer. I think you really have to know your customer in order to provide products and services that are responsive to their needs, as well as materials that is responsive to their needs. One of the things that I can say is that when I think about my Hispanic banks, they are very intentional about working with their partners to ensure that their partners understand that. So whenever they're creating a new partnership with Fintech or a government agency, they are very intentional at making sure that their partners understand the uniqueness of the demographics that they're serving.
Right, and what about the contractors that you all may use? Like, I know I have a loan through a credit union, but I have always had problems with the folks that service the mortgage. I mean, I don't want to get to war stories, but they don't provide everything in Spanish, and that's where the problem becomes, because that may lead to misunderstanding, delinquencies, and maybe even repossessions, depending on what they bought.
Yeah.
Thank you very much. The gentle lady's time has expired.
Yield back, Madam Chair.
Thank you. The gentlewoman from Georgia, Ms. Williams, who is also the vice chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you to all of our witnesses who have waited until the very end today. When marginalized communities can access capital, we can help secure the promise of the American dream for all of us. And today, I'd like to focus on the impact that lending from mission-driven financial institutions can have on solving the affordable housing crisis in this country. In Metro Atlanta, we only have 29 affordable and available housing units per 100 extremely low-income households. The national average of 37 isn't much better. And y'all, we can't afford to not make big investments in building and updating our nation's affordable housing, including by empowering mission-driven financial institutions focused on housing. A CDFI in my district, the Atlanta Neighborhood Development Partnership Loan Fund, has financed thousands of affordable housing units through the years. Mr. Bynum, how can we encourage more existing mission-driven financial institutions to make affordable housing production the focus of their lending?
Thank you, Congresswoman. This is so important. As I mentioned earlier, nothing closes the wealth gap more than housing and ownership, business ownership, home ownership. Home ownership perpetuates business ownership. They build equity, and you can do things, and you can invest in entrepreneurship. I think I also appreciate your distinction of mission-driven CDFIs, one that are actually going to drive capital into the communities that lack access to, have not been able to get mortgage loans from traditional financial institutions, or developers that need financing to build affordable quality rental housing. And that's where CDFIs come into play. I think, again, building on the work that you've done, let's finish the job, let's continue and sustain programs like ESIP and drive them to not just banks and credit unions, but loan funds as well. And let's bring HUD into the picture. Down payment assistance is critically important. You cannot, we have a 100% down payment product. That's something that we choose to do because it helps us to drive 80, 90% of our loans to first-time home buyers, to minority and women borrowers. But down payment assistance will be critically important, as well as making sure that CDFIs have the capital to provide the financing that these entrepreneurs, that these homeowners and developers need to provide the services that you described and that are so important.
And Mr. Bynum, no place is this more evident on the need to close the racial wealth gap than Atlanta, who unfortunately leads the nation in the largest racial wealth gap. So we clearly have our work cut out for us. And in 2020 alone, CDFI dollars financed 50,000 new affordable housing units. However, when we're looking at a deficit of nearly 7 million affordable housing units across the country, we know that we still have a lot of work to do. So, Mr. Biden, what kinds of changes or resources would it take to expand the number of mission-driven financial institutions funding the development of affordable housing in a way that better meets existing need?
Yeah, I think again, more capital. You got members of Ms. Elam's association that are banks that are ready to grow if they have the capital. So same thing with credit unions. The NeighborWorks America, the organization you mentioned, is a part of NeighborWorks America that drives grants to help them build their capacity. I think Mr. Sands is a great example, as well as Luz's organization, of how fintech properly targeted can help expand the deployment capacity of CDFIs. I think also making sure that we use the tools that exist to hold banks accountable, as well as CDFIs. The Community Reinvestment Act, fair housing has been under attack, and we need to make sure that those are shored up and that ensure accountability in deployment of capital that is supported by federal government. You can't have CDFIs that widen the capital gap or banks that widen capital gap. They've got to be held accountable to deploy capital in a way that ensures access to everybody, regardless of their race, gender, or place of birth.
So, Mr. Biden, when mission-driven financial institutions are best positioned to invest in community assets like affordable housing and extend mortgage credit to borrowers of color, they can address longstanding economic inequities that impact people who look like me. So you made several recommendations about how to best position mission-driven financial institutions to close the racial wealth gap. And if these are implemented, how would you characterize the impact that these financial institutions could have on closing the racial wealth gap?
It will be transformative. Also would encourage us to use Fannie and Freddie to drive them even more in this direction. They play a critical role, but it will transform this economy and make us the more perfect union that we say we want to be.
Thank you, Mr. Bynum. And Madam Chair, I yield back.
Thank you very much. Do we have any more members on the platform? If so, now is the time to identify them. We're about to close this hearing. If not, I'd like to take a moment to thank our witnesses for their testimony today. Your testimony here today will help me and the members of my committee help take our MDIs and CDFIs from being overlooked, and we will not only not overlook them, we're here to make sure that we understand the capital needs, to make sure that there's cooperation with Fintechs, and to deal with all of those issues you have identified, whether it's CRA, other kinds of issues. We are now focused, and we now have the opportunity to correct some of the ills that have been present for so long, dealing with financial institutions such as our MDIs and our CDFIs. And so, without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I thank you all so very much, and this hearing is adjourned.
Thank you, Madam